There's clearly a sense of optimism and enthusiasm out there, just given the strength of the market.
We should anticipate that we can get back to that pre-COVID labor market.
As the countries move out of the COVID, their demand for basic raw materials is going to be very, very strong.
As this global recovery is unfolding, investors need to think more global in their portfolios as well.
Valuations are very, very challenged, though, but the fundamentals are going to keep getting better here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Wrapping up the second quarter from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures down 7 on the S&P. We're negative a little more than 0.1%. Closing out June potentially, Tom, most likely with a 5th straight month of gains.
It is. It's an extraordinary second half. And, of course, June looking well. The rally yesterday, really in the last half hour, John, really caught my attention, even with the futures now negative. John, what I'm going to notice here is let's go right back to the vanilla spread. You've been talking with Lisa about a flatter yield curve. Well, I'm sorry, it's ever flatter. We're not due to 117 basis points on the 210 spread, but this is a huge signal of what's to come. This flatter curve, John, to me is a huge surprise.
This has been the thing for me at the end of 2Q. This last month, Tom, break-evens topped out in May. As you point out, the yield curve is flatter, it's not steeper. And when you look at the performance of this equity market, NASDAQ 100 up 6% over the last month. Big banks, the S&P 500 sector, that is down 6% over the last month. That's quite a divergence.
Yeah. And we enter 4th of July weekend with the real yield. Look for that Friday afternoon after the jobs report.
Thank you, TK.
10-year real yield negative 0.89%. It hasn't budged in any way, shape, or form. And away from the equity market enthusiasm, John, this fixed income space is something we can talk about this morning.
So, Lisa, we have to play the what next. Here's the quote from Peter Cheer over at Academy. Take some gains, reduce risk, and enjoy a few weeks with less stress.
I can endorse that. I don't know if I necessarily would take the chips off the table, but definitely less stress and take some time off. There is a question I heard in a number of different analyst reports, buckle up, buckle up, buckle up, buckle up. But we're not seeing any potential volatility being implied into spreads when you look at the Bank of America Merrill Lynch Move Index or the VIX. And I do wonder what's going to be the catalyst, John, because honestly, the Federal Reserve, the main core of the Fed, has really doubled down on the transitory message.
Well, let's talk about credit spreads. Lisa, a couple of weeks ago, had just a mini stress test for this market with a Federal Reserve decision. What did credit do?
Tightened.
Not much, right?
Yeah, absolutely nothing. I mean,
rock
honestly,
solid, resilient.
And the bottom line is this: if companies can access funding, what's going to stop this cycle?
Can I mention something, John? I think it's going to be the theme for the second half.
Yep.
Real wages are flat on their back. Lisa Abramowicz put a chart out on Twitter. I followed up with another chart. We don't need to go into the details now, John, but inflation-adjusted wages are a disaster.
We'll go into the details in just a moment, Tom. Here's the price action this Wednesday morning. Good morning to you all. Equity futures down 6 on the S&P, 22.77 on the S&P 500. A very small breach of 4,300 on the S&P 500 in yesterday's session. 145.61 on 10s. Yields come in around about a basis point, and in foreign exchange, the euro south of 120, 118.92, Lisa, unchanged on the day.
Yeah, and no matter what data we get, it seems like the pressure is lower these days for the 10-year yield. And that, to me, is the story of the second quarter of the year. This today, that's where we're at. We're a Wednesday. Happy Wednesday. 8:15 a.m., we get the Adp Employment Change. Not necessarily that predictive of what we can expect for the jobs report, but we're expecting less of a gain. 600,000 added jobs with particular focus in the service sector, particular leisure and hospitality. This is down from 978,000 in the previous read. How much does this foretell perhaps a weaker than expected jobs report on Friday? Again, not typically that predictive. 10 a.m. U.S. May pending home sales. The expectation is for a slight decline after yesterday we saw home prices rise the most in 30 years. This is creating affordability issues and also inventory issues. Just are not the homes to necessarily buy, which is the reason why people are expecting a slowdown in the pace of sales. And then today, the OECD is meeting to talk about that global minimum tax, at least 15%. The expectation is by implementing this minimum tax, it could help countries raise more than $150 billion. Again, I wonder how big of a shift this is going to be. This is directed at the likes of Ireland. How much pushback are they going to to make? What kind of loopholes are they going to close? And what is the time frame ahead of the G20 meeting next month? What is the time frame in terms of implementing this, John?
Lisa, you mentioned home prices, the fastest home price growth in America in more than 3 decades. Governor Waller had this to say in an interview with Bloomberg yesterday afternoon. I am much more sympathetic to tapering MBS first. Lisa, you've talked about this. Is the pressure building?
Yes. Well, here's the question. Again, does the Fed's Waller matter? And we talked about this because we've been talking about how the top 3 members, the ones who set the tone. And the issue is if they start tapering the mortgage purchases, that signals a rate hike. That signals to markets we're tightening. And does the Fed want to get on board with that? It might seem to make sense to tailor it. However, it is not so surgical when it comes to the Fed balance sheet.
What do you think, TK? Is this housing market in America getting a little bit too hot?
It's too hot, but it's also very segmented. I think there's been some very good reporting on it. What I'm going to tell you, John, is it's 900 miles from Spokane, Washington to Washington, D.C. I thought Zero Hedge did a tour de force job yesterday afternoon showing the rent dynamics of San Francisco, yes, plunging, now in recovery, versus cities like Spokane, Washington. John, this is in western Washington towards Montana. I know you're unfamiliar with the map. And within Spokane, Washington, rents never really went down, and now they're going up. And I think
I
it's
love how you do this.
This mid-city story like Spokane, Washington.
Thanks.
You know, it's like a huge deal. Rents are going up.
Have you ever been?
No, I have.
There we go.
No.
At least we've both got that in common. Andrew Hollenhorst joining us now, City Chief U.S. economist.
They have wheat.
Andrew, let's just start with this one right here. The housing market in America. Do you think the numbers that we're seeing at the moment should influence the Fed's next move?
I think it has to be something that the Fed is thinking about now. I mean, you look at mortgage rates that are at record lows, you look at house prices that are rising at record fast rates, and then you look at the Fed buying $40 billion of mortgage-backed securities a month. And I think that there's a reason that those mortgage purchases were started. I think the reason for continuing them is becoming a bit more challenged. Now, that's not to say that they need to move immediately towards a taper, but I think when you hear people like Waller talking about, should we be looking at this? Should we be thinking about this? Certainly something you should be thinking about here.
Andrew, I want you to talk about the partitions of America and what it means in the second half for Jerome Powell. You look at real wages, and there's all sorts of nuances between first quartile and second and third quartile lower wages really doing poor. Or you've got the real estate we just mentioned, the difference between San Francisco and Spokane. Can the Fed aggregate this natural disaster of a pandemic, or are they going to focus on San Francisco or Spokane?
Yeah, I think you're getting at a really important point here, Tom, which is that, yes, we had a huge aggregate shock to the U.S. economy, but the way that this shock has transmitted itself throughout the economy has been very unequal across regions, across income groups. And then you think about what the Fed can do to address this. And the Fed really only has a few fairly blunt tools, right? You can raise or lower interest rates, you can buy or not assets. So when the Fed's looking at this, yes, you can think about trying to keep interest rates low, trying to hope that that boosts real wages at the bottom end of the spectrum. And to some extent, you are getting some nominal wage increases for lower wage jobs right now, which is a good thing. But the issue, which I think you're also pointing out, is prices are rising. And if prices are rising faster than wages are rising, then those nominal wage increases don't actually translate into real buying power.
Andrew, this goes to the heart of a conundrum. The Federal Reserve, people argue, has been actually exacerbating wealth inequality by bidding up the prices of assets and not necessarily having the same commensurate effect in the real economy as evidenced by what you were just talking about, the real wages. Do you think that at this point, by doubling down on easy money policies, that the Fed is exacerbating some of the higher prices, that higher inflation read, and not necessarily adding to the increases in wages that could offset that for the average American?
I think it's a risk that the Fed needs to be taking into account when they're setting policy. So, if you think about where we came from, and it really wasn't that long ago, 6 months ago, a year ago, when the economy was really deeply, deeply depressed due to the pandemic. So it made all the sense in the world to just talk about easy monetary policy, a long period of accommodation. And really if you think about the Fed's dual mandate, employment, inflation, and then you also think about financial stability concerns, the real concern should have been employment, and that should have been kind of the only concern. So I think that made a lot of sense. I think that the difficulty now is that the recovery has just been so much faster than many people thought it would be. things have happened much, much more quickly. We've got into a tight labor market. We have wages and prices that are rising. So the Fed now needs to transition and think about risks of higher prices, higher inflation, as well as this kind of inequality issue with asset prices.
ADP report a little bit later this morning, the appetizer for payrolls on Friday, Andrew. What are you and the team looking for?
So we think payrolls will be strong this month. We're have a base case forecast of 860,000, which would be, a strong reading. We've been averaging about 500,000 a month. And I think as long as we average somewhere around there, the Fed will still be happy with what we're seeing and we'll still be on course to taper. Of course, the big question in this jobs report is not so much what the headline jobs number is. Is the jobs market being held back by issues with demand, or is the jobs market being held back by issues with labor supply and labor shortages? And anecdotally, as well as in some of the data, that's increasingly what we're seeing now.
Andrew, good to see you. Andrew Hollenhorst there, the city chief, US economist, ahead of payrolls this coming Friday. Your estimate, 700,000. That's the median estimate in our Bloomberg survey. Just a quick question from me, guys. Did you have the man from Del Monte back in the day? Do you remember that, Lisa, the man from Del Monte?
No.
You should Google the man from Del Monte.
Doing it right now.
Just have a quick Google and have a look at the man from Del Monte, and then tell me what you think about the current outfit of Tom Keene.
I know where this is
summer
heading right
Wednesday.
now.
Do you know the man from Del Monte is?
No,
Tom?
I have no idea.
Famous commercial about fruit
About
from the UK
fruit,
a couple
okay.
of decades ago.
Thank you.
The man from Del Monte
John, you and
says
I,
yes.
we got to give some love
as
to
he's selecting the
992.
fruit.
John, we got to give some love
Have a
to.
look at that, Lisa. Go on, TK. Go
We
on,
got to
carry
give
on.
some love to 99205, Spokane, Washington. You and I need to go out there. Great breakfast, whether it's Frank's Breakfast or Mary Lou's Milk Bottle. It's an iconic kind of architecture thing, John. I think a road trip's in order.
I'm told it's 2,500 miles away, Tom, not 900, like you said a little bit
No,
earlier.
to San Francisco.
Oh, okay.
The
From
difference-
900 miles from San Fran.
The real estate,
2.5
I think,
to
John, I
DC.
think this is a huge important. It's like the difference, John, between the real estate and the city and Notting Hill.
All I can
it's
say,
a huge disparity.
I would love to see the Google searches during the show.
The man
for
from
each
Del
of you.
Monte Spikes.
Yep, the Del Monte
Man from
Spikes.
Del Monte.
The distance from Spokane, Washington to New York
DC.
City. Yeah.
All of the above.
Yeah.
This is going to be a great show, isn't it? In the next hour, Jared Woodard of Bank of America is going to make it even
Is it
better.
up to 95 today?
Equity futures down 5 on the S&P, 42.76. And as TK points out, it is going to be a steamy one
Yeah.
in New York
Who's
City.
England play next?
They play Ukraine, Tom.
Ukraine.
Yeah, big game. Big game coming up on Saturday.
Great.
42.77 on the S&P 500. Good morning to you all. This is Bloomberg.
In England ties.
With the First Word News, I'm Ritika Gupta. In North Korea, Kim Jong-un says a grave situation stemming from quarantine negligence has created a crisis. Kim hinted at coronavirus risks that could affect his rule. The regime has long denied that North Korea has had any infections. State-run media isn't providing any details. North Korea has taken drastic quarantine steps that have made its economic crisis worse. And a divided U.S. Supreme Court has refused to lift the federal moratorium on evictions during the pandemic. That will leave the ban in place until the end of July. The vote was 5-4. Justices rejected calls by landlords and real estate associations to block the moratorium while their challenge goes forward. The plaintiffs argued that the CDC exceeded its authority by imposing the ban. And a big foul-up in vote counting in the race for mayor of New York City. The city's Board of Elections took down previously reported results in the Democratic primary after mistakenly counting test ballots. That produced about 135,000 dummy ballots that skewed results. The inaccurate count showed Brooklyn Borough President Eric Adams losing a large part of his lead over former city sanitation commissioner Catherine Garcia. And SpaceX founder Elon Musk is unhappy about rules that forced a scheduled launch to be scrubbed in Florida. The mission was delayed after an aircraft entered the so-called keep-out zone around the launch site. Musk calls the restricted area unreasonably gigantic and says the current regulatory system is broken. The FAA says the system worked and kept people safe. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is a generational investment to modernize our infrastructure, creating millions of good-paying jobs That's not coming from me, that's coming from Wall Street. Millions of good-paying jobs and positions America to compete with the rest of the world in the 21st century.
The President of the United States, Joe Biden, from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Wednesday morning, after closing out yesterday with the smallest day of gains to complete a 4-day winning streak and another all-time high in the S&P. Equity futures down 5 as we close out the second quarter and the first half of the year. We're down a little more than 0.1%. Yields in TK, 145.45, down a little more than a basis point on the day. And a euro south of 119, weaker, negative 0.11% on that currency pair. Euro dollar, 118.84.
Yeah, 3 days of Labor Day to shift things up here. Again, ADP Mike McKeel stopped by in the 8 o'clock hour as well. And John, again, I would just simply go to the fixed income market and what we see in spreads as being really indicative of moving away of the certitude of what we saw in February of this year. Let's do this right now. Every once in a while, an essay comes along that redefines the landscape in Washington. It's no surprise that David Ignatius could write that up in the Washington Post as well. Anne-Marie Horton joins us on the tone in Washington, our Washington correspondent. Anne-Marie, David Ignatius talks about a hugely difficult thing to do, and we've seen this way, way back, I would say back into the early 19th century, this shift from a senatorial tone, the happy, the backslapping, the smiling, over to a presidential tone, what that might be. How is President Biden doing in making the shift from senatorial over to presidential?
Well, if you read that opinion piece by David Ignatius in the Washington Post, it sounds like, at least from his perspective, a little bit more needs to be done by the president. He talks about the fact that he was so giddy to announce this infrastructure bipartisan deal with those senators, but he says he needs to take that backslapping, that giddiness you'd find in the Senate, and really hone his skills in the Senate, but to achieve it and become presidential. And that's the only way he's going to be able to get his legislation through. And right now, Tom, they're able to have this bipartisan infrastructure deal, but the president and this administration wants to work in tandem, a two-track road ahead to also get a larger deal done through reconciliation. And that means that the White House has been calling, and we saw the White House counselor Steve Ricchetti talk to the Progressive Caucus yesterday, and to make sure that their own party is in line. And that is where there's really tension between the moderate Democrats and those on the very left.
What's interesting here is the need for discipline. When does a president step in and start with what every president has to do, which is get on the phone and structure a discipline, in this case, within a fractious Democratic Party? Does that happen now, or does that happen in the cooler autumn?
I imagine that happens in the cooler fall, Tom, just because he has his whole staff working the phones, going up on the Hill, and talking to the progressives. Also, what you have right now is they are still working out what they want in this deal. I don't think we've got to a level. There's been no pen to paper. There's no level that the president needs to pick up the phone and push this over the line just yet. One of the key sticking points is the price for this. You have Senator Bernie Sanders looking at a $2 trillion bill, while you have the likes of Senator Joe Manchin from West Virginia talking about the fact that he won't even put a price tag on it yet, wants to make sure it could be paid for, and then speaking over the weekend saying he's for higher taxes, but not as high as some of the progressives like. So there's still a lot of wrangling between the Democratic Party that needs to be done before I think the president gets involved.
And Maria, at what point does President Biden have to take sides? I mean, right now he's trying to please everybody. He's saying on one hand, yeah, we're going to have this bipartisan deal. He's saying to the progressive Democrats, yeah, we're also going to have a $6 trillion plan that can further my spending. When does he have to actually say, okay, I'm going bipartisan or I'm going partisan?
I don't think we're going to hear that just yet, Lisa. And to the opinion piece Tom's pointing to today, David Ignatius is talking about the fact that the country doesn't want to hear that. The country wants a middle-of-the-road approach after what we saw of 4 years of divisiveness in Washington, D.C. But to get both of these individual bills accomplished, the president is going to walk this fine line, at least for now. Remains to be seen if he's going to have to be pushed one way or the other.
There's also a question about whether he has a plan for how to do this, or whether he's trying to appease everyone, and whether it was not that coordinated. The idea that he was touring Wisconsin, he was touring a Republican-leaning country at the same time that he's also shifting gears to try to bring Democrats back on board. How cohesive is his strategy, at least as perceived by those in the Beltway?
Well, right now, as you say, when he was in Wisconsin, it was definitely speaking to those that voted for President Donald Trump, a really Republican base. But we cannot lose fact of that his staff is here in Washington, D.C., up on the Hill, talking to the Progressive Caucus and making sure they could start hammering some of those key things that the progressives want to see in a larger infrastructure deal. Things like free community college, things like Medicare, lowering Medicare costs. So he is working these two tracks. I understand your point from a PR perspective. He was definitely in GOP territory, but his team is certainly working the phones with the left.
Anne-Marie, just briefly, we'll hear from the president again, I believe, a little bit later this morning. It is hot, hot, hot here in New York City. It has been scorching on the West Coast.
Yeah, it certainly has. And at 11 a.m., John, he's going to be making this announcement talking about the heat and also what it means in terms of electricity grids. He made a nod to this yesterday in Wisconsin, especially on the heels of what we saw this past winter with potential collapse of the Texas grid due to extreme winter weather. Now the worry is, what does the heat do? And you guys are sitting in New York. I don't know if any of you got a call from Con Ed, but it's not just the Pacific Northwest where you have worries about wildfires as well, but it's throughout the entire country, especially in the Northeast as well. You do have these worries about electrical grids, and we're only at the end of June. We're not even in July and August yet. So it's definitely going to be a hot summer, and the president's administration is starting to prepare for that.
Anne-Marie, thank you. Looking forward to catching up through the day. Anne-Marie Horden, our Bloomberg Washington correspondent down in D.C. Tom Keene, this weather is no joke.
It's no joke, and it shifts the dialogue. I don't care what anybody says. I looked carefully yesterday, John, at the drought map, and I know there's a fear of the drought moving west. It's barely into western Colorado, and if it moves farther to the east, rather, well, you know, that's not good. What I would focus on, John, is the overlay of it, the template of it into Q3, and what it means for GDP, utility expenses, and such. And then, John, you've got the health issues, which they're already seeing in the Pacific Northwest. Yep. I know Vancouver with some really difficult statistics.
Lisa, what's your take?
Okay, this from a New York Times essay yesterday. Extreme heat is the deadliest form of extreme weather in the United States, causing more deaths on average than hurricanes and floods combined over the past 30 years. Just to give you some perspective, when you think, it's just hot outside. No, it's lethal. And that's what we're seeing. And to me, this does change the dialogue, as Tom says.
Don't ever let Lisa Abramowicz do the weather report. Hey, Tom. But Lisa, I know a serious point.
No,
a very serious point.
I don't mean to go super dark, but I thought it was pretty interesting.
I'm with you. Happening right now, elsewhere, Bloomberg's New Economy Catalyst Conference, bringing together innovators and creative thinkers discussing solutions to society's greatest challenges. Watch online at the New Economy Forum website. And Bloomberg subscribers can watch on Live Go.
Yes. The man from Del Monte. The man from Del Monte.
The man from Del Monte. What does he say, Tom?
He'll be there, fedora and all.
Cheers. He says yes. Live from New York City for our audience worldwide. Wednesday morning, good morning. Here's the price action. Equity futures, 42.78 on the S&P 500, down about 3 points. Negative almost 0.1% on a 4-day winning streak on the S&P 500. Longest winning streak going all the way back to March. On a monthly basis, a 5th straight month of gains on the cards and a 5th straight quarterly gain as well on the quarter, up by 8% and changed on the S&P. I'll do a little bit more of that in the next hour. Switch up the board and get to the bond market. Over the last quarter, yields come in 29 basis points on 10s after exploding 83 basis points through the first quarter. Second quarter, yields in has been the story, 145.45, and a more defensive posture in the equity market over the last month, reflecting the fact that break-evens topped out back in May. When was the last time you heard about break-evens? Exactly. That gives you a hint of where things have been going. That's the bond market. Switch up the board and finish in foreign exchange. Euro-dollar. Euro-dollar shaping up as follows. 118.86 in about 1/10%. Negative 1/10%. In the dollar's favour against the euro. Euro-dollar 118.87. The euro has been a struggle over the last couple of weeks.
Yeah, it's been a struggle. Yeah, well, explain why. I mean, I'm sorry, John. This is one of the surprises of the last 30 days.
I think you've got to look at the dollar side of the story. And that incremental evolution in the Federal Reserve communication, just a switch of emphasis away from transitory to a more balanced view of the risks about the outlook, and that engineered just a nice move in the US dollar, and it's been a struggle elsewhere.
And I would suggest also the silence of the ECB. We'll do much more on that into July. A couple of housekeeping notes right now. Anthony from Sparta emails in. He says, on radio, we can't get the full joy of the man from Del Monte. For those of you on radio worldwide, I'm wearing one of my beige suits. I wear the suit to weddings and divorces both, and it really works out well. But we thank the good people of Oxford, Chicago for helping me out with my sartorial selection this morning. Also, always sartorial, Ron Temple joins us now from Lazard Asset Management with a really brilliant note. And Ron, I love with the short term at Lazard Asset Management being 2-3 years. I love how you extend out to an elevated but not a panic inflation for 2024. Should I be worrying about inflation?
No, I don't. I think you should be thinking about inflation, but I think the debate about inflation should move out of this debate in the tails and really start focusing on which side of 2% are we going to land on. And when I think about the next 2 to 3 years, I think increasingly the probability looks like we will land in that 2 to 3% zone. So again, nothing alarming. We're not going back to the 1970s. But it does have meaningful implications for asset allocation.
Let's go back to the giant Phil Correa of Pioneer Management, living out well to 100 years. Plus, Mr. Correa always talked about the bright lights of nominal GDP. Does a Temple, or for that matter, David Fokerts-Landau at Deutsche Bank, does your elevated inflation give me a larger nominal GDP, which gives me a good stock market?
I do believe it does. I'm quite optimistic. I think we've got quite a bit of runway on GDP, and that's why I think we're going to land in that 2 to 3% on inflation. We've got tremendous pent-up demand from consumers. You've probably heard these numbers over and over, but U.S. households have over $2.1 trillion of excess savings, and I do believe we will get incremental stimulus from the federal government through infrastructure, kind of to the conversation you were just having. So I do believe there's quite a bit of momentum, and it's going to spread out into 2022 and 2023.
So, Ron, a lot of people want to know what to own in the back half going into 2022 and beyond. What has worked over the year so far has been a cyclical story. More recently, though, over the last month, that's broken down a little bit. Big tech outperforming the banks on Wall Street. What would you like to own through the back half and into next year?
Now, I actually think if you agree with my forecast or my view that we're going to see inflation landing in that 2 to 3% zone over the next 2 to 3 years, that to me says you're going to have a steepening yield curve. And we're going to go back to the dynamic we saw more in the fourth quarter of last year and the first quarter of this year, where those cyclical, traditionally value-oriented stocks outperform growth quite materially. So I think the real point would be to look and try to understand what are the returns on capital a company can deliver now and in the near term, and are they sustainable in this environment? And then compare that with the companies that have been driving the market for the last 5 years, the highly speculative companies that are driven by cash flow 5-10 years in the future. I think you're going to want to own those more cyclical companies who can give you returns on capital now, higher quality now, as opposed to hopes for the future.
So, Ron, where does energy fit in to that thinking?
Energy is a tough place. I mean, I think back to the topic you were just discussing around what we're seeing in terms of the weather environment in the U.S. I mean, you'd have to be living in a state of denial not to recognize the reality of climate change and what we're going to have to do to face that challenge across the developed world and the emerging economies. So I think when you get into energy, there are definitely opportunities there, but you have to be very mindful of the sustainability of some of these business models and the risk of stranded assets and the transition we're going to have in energy.
So does that mean that you're buying or selling?
I am not bullish on the fossil fuels. I mean, I think we need to be looking at adapting our entire infrastructure and looking at the opportunities for the new energy transition we're going to see in the markets. The big challenge there is identifying opportunities where valuation is attractive. And I tend to think the best opportunity related to energy more broadly defined is probably in parts of the industrial sector that will basically make this energy transition possible. And those you can find some very good valuations and attractive companies.
There's also a question going forward, how much has already been brought forward at a time when people have already expected that growth, expected the infrastructure spending boost. I mean, how do you determine what's been priced in already?
No, I think this is where the bottom-up fundamental work that we're known for at Lazard is really important, trying to kind of go through each company, understand what our forecasts are. And I do think there are a number of pockets in the market where we can still find opportunities that might not be directly related to infrastructure or cyclical upswing. I do think in the financial sector, I still see upside there. I think some of the banks have actually demonstrated through this cycle that they could deliver higher trough returns than we would have thought before. The fortress balance sheets they developed partly as a result of regulatory oversight. have really helped them. I also think if you go into the healthcare space, there's some pretty exciting things going on in the med tech area. And again, this has nothing to do with infrastructure, but if you think about recovery plays, there were quite a few medical procedures that did not happen in 2020 because they were deemed to be elective. And I put that in quotes because I don't know about you, but I don't consider getting a pacemaker something I want for Christmas. I think these are things, though, that people might have needed and they couldn't get done. And we could see a pretty important increase in demand over the next several years as we catch up in those areas. So I think there are quite a few areas in the market with good opportunities.
Right.
It's all about the security selection.
Ron Temple, combine the Lazard asset management work with your outside resources on an earnings call for the Standard & Poor's 500. We've got great debate on this show about what earnings will be. Which way do you go directionally?
No, I'm looking for strong earnings. I think there's still upside in terms of earnings expectations. I think companies have managed to do this well. There are definitely going to be some kind of, shall we say, idiosyncrasies and volatility because of the supply chain bottlenecks we've seen. And I do think a lot of economists are trying to grapple with this challenge right now. Predicting our way through a pandemic was impossible. We didn't have a roadmap. There are a lot of considerations we didn't think about on the way out of the pandemic. So I'm trying to be mindful of that, and we all have to be humble. But when I look at the broad market, I still see a strong revenue trajectory and a strong earnings trajectory that I think will extend out for several years.
Well, the whole episode over the last 18 months or so has been humbling for everyone, Ron, to some degree. So it's an important lesson, I think, for us all. Looking forward is really tough. Looking at the incoming data, that's been hard too. This is what BMO had to say. There is plenty of fundamental justification for ignoring the data at this stage in the cycle, not least at which being the ongoing lack of context for the magnitude of these surprises and the misses as well. Ron, the incoming data, how do you interpret it as a market participant on any given day going into payrolls, say?
Well, I'm never going to say ignore the data, but I fully understand why they said that. I mean, my key point around looking at the data right now is let's not overreact to any single piece of data in the near term. In particular, back to the inflation discussion. When I think about inflation, I think the key data to watch is really going to be coming from August through the end of the year. And in particular, I focus on that area because we know there are a number of bottlenecks in the economy, whether it be transportation issues, semiconductor shortages, labor dislocations. But I think the labor piece of that, we're going to get a lot more clarity as we head into the new school year. As children go back to school physically, that will free up many parents to go back into the labor force. 3.5 million people have left the labor force since the beginning of the pandemic. And I would bet a large majority of those people are because they have to be at home with their children or with elderly relatives they're caring for. We're still down 7.5 million people on unemployment. So when we get into September, you're going to have schools back in session. The expanded unemployment benefits will expire nationally. And I think we're going to see then how the labor market basically gradually returns to normal. And I think that will also help people kind of get these inflation fears under wraps.
Right now, is that your way of saying that you think that the bias in markets perhaps is a little bit too much inflation down the road? Is that your sense?
Well, it's interesting. I think prior to June 16th, the market was probably thinking too much about inflation and was overly worried about inflation. And again, part of why I started by saying we need to move out of the tails of the discussion. I think there was too much debate about the Fed losing control of inflation and the idea of you might have, rampant inflation. With June 16th, I regret that the Fed, in my view, blinked and succumbed to market pressure. I think the Fed might have damaged its credibility around the new flexible average inflation targeting. And I think what we're going to see over the rest of the year is maybe the positive of that message on June 16th was the Fed bought itself time to let the data come through, prove to the markets that this is not a debate about 4% inflation, but it's more a debate about 2.5 versus 2. And so I think that's the message I would have around inflation.
We've spent 6 months arguing over 50 basis points, Ron. Is that it? Ron Temple,
I think that's
management.
True.
Ron, it's good to catch up. Thank you.
And guess what we're going to do the next 6 months
We're going to
doing?
spend 6 months arguing over 50 basis points. Look, some people think it will be much more than that, so I won't get into that debate at the moment. One thing that keeps coming up again and again and again, though, repeatedly, is August, September time and beyond. That's when this really starts to count, the incoming data, Lisa.
Yeah, the idea here also that this will coincide with the Jackson Hole meeting when the Federal Reserve will have to start indicating that they are going to taper if they're going to do it within the next 6 months. I don't see how things are going to materially change by August. Perhaps September will get more of an indication. But I've got a feeling people are going to be saying, the data's still noisy, the data's still noisy. When do you think we're going to get an all-clear sound?
Well, Tom, we keep coming back to August, September to wait to see cleaner data, apparently.
Yeah, well, we're waiting for August, September. I like the school idea in that. I would just suggest, John, you've got to study where was I wrong in January and February. That kind of question has to come up here. And I have real trouble, frankly, John, with the certitude now as I did with the certitude in January. We're in the middle of a natural disaster. We haven't even touched on Delta.
We'll do that next. Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine from New York City this morning. Good morning. We're down 4 on the S&P, negative about 0.1% to 42.78. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Your equity market at all-time highs in New York City. It's going to be a hot one. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The U.S. and Taiwan will discuss semiconductors and vaccines today at a long-delayed trade talks. There's a global shortage of computer chips. Taiwan is one of the main suppliers, and its biggest manufacturer is building a new factory here in the U.S. Taiwan's eventual goal in the talks is a full trade deal. In Congress, a rare show of bipartisan unity over tax policy. 18 lawmakers from both sides of the aisle made their case in the House why an expansion of the state and local tax deduction should be included in upcoming legislation. The so-called SALT deduction is a top priority for lawmakers from high-tax states such as New York, New Jersey, and California. The British government has revealed its post-Brexit system for overseeing subsidies to companies. It's promising to make quicker decisions than when the country was in the European Union. Subsidies will be allowed if they follow certain principles, like benefiting local communities and being good value for the taxpayers. In Hong Kong, another blow to jailed media tycoon and activist Jimmy Lai. Lai's company Next Digital says in a memo to staff that it will cease operations tomorrow. Next Digital is the publisher of the now shuttered pro-democracy newspaper Apple Daily. The paper closed last week after Hong Kong authorities used a Chinese security law to arrest editors and executives. And Credit Suisse is considering an overhaul of its wealth management business. Bloomberg has learned the Swiss lender may consolidate several private banking units. The move would replace a regional structure, and it may reduce costs as well as present a more unified approach to clients. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
What we are doing on the vaccine side is to test all known variants against the vaccine and the immune response that we see to the vaccine. And indeed, yesterday, we presented data that indicates that at least the Delta variant is covered. But we do have to be very, very careful because we just can't anticipate fully what's next, and we have to keep testing and, if needed, adjusting the vaccines over time to be able to also protect against new threats.
A fascinating conversation with Francine and the team earlier this morning. That was Noubar Afeyan, the Moderna co-founder and chairman, speaking earlier at Bloomberg's New Economy Catalyst event from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Equity futures 42.77. Equities down a little more than 0.1% in the equity market, pulling back from record highs potentially after 4 straight days of gains. We just about managed to squeeze one out yesterday. Yields down 2 basis points to 145.11, and that dollar strength in the mix through G10. Euro dollar 118.88. Tom, we're negative there, 0.08%.
A Wednesday of window dressing. We'll see what, but John, that's absolutely accurate the way we squeezed it out yesterday afternoon. Right now, with an update here after that important conversation with a gentleman from Moderna, Lauren Sauer joins us from Johns Hopkins University. Lauren, I was thunderstruck. I read carefully the press release from Moderna yesterday, and they had a sample size, I believe, of 8 people. It really shows that the pros like you are totally fired up on analyzing Delta, Alpha, Beta, whatever the variant is, and the rest of us are out with 15,000 people watching baseball. What are we going to need to do to get America engaged as your profession is engaged right now?
Well, I think it's where creeping towards fall, and the hope is that we'll continue to really dig into the data over the next few months to understand how the coverage is going with especially with the Delta variant, which is absolutely gaining strength across the globe. I think these small studies are helpful because it's what we have, right? So it's better than nothing for sure. We definitely want to see more data from the CDC as they continue to look through their breakthroughs. I would love to see a publication from the CDC on what their breakthrough data is showing, perhaps pushing towards some new vaccination strategies to build protection. But these small studies are what we're going to have to keep looking at as we continue to inch towards better coverage with the vaccines and the growth of the Delta. It's sort of a race right now.
If the key factor is the unvaccinated, do you just assume Delta variant could be highly regional or even rural, urban?
Yeah, I think it's that unvaccinated, and I think a lot of us are concerned about what might happen with that single dose vaccinee population. So we did see some good data from Pfizer. We think Moderna is going to be protective. It's the Johnson & Johnson vaccine, people who've had that single dose vaccine. And so perhaps there will be some changing vaccination strategies. We're seeing this in other countries where they might get a booster, like someone who got J&J might get a booster of another vaccine, for example, or also chasing down the people who have only gotten one of their doses and making sure that second dose regime is being followed. But yeah, those pockets of unvaccinated individuals, we're going to really have to focus efforts on the regional areas where we see low vaccine so that we don't have pockets of large groups of people getting sick and ending up in hospitals and those hospitals being overrun.
Lauren, when do we have to stop worrying about Delta and start worrying about Theta, Eta, Omega?
Yeah, I mean, right now, Delta is definitely the concern. It is inching its way across the globe, and actually not even inching, it's going quickly across the globe. And so I think we will continue to have to keep an eye on it. We will continue to look at new variants as they pop up, making sure that our sequencing capabilities allow us to keep doing that. So continuing to collect specimens, continuing to do the hard surveillance work that our public health entities are doing. But I do think that as vaccine coverage increases and we have these great vaccines, which is incredible, the new variants become less worrisome. So the more we can uptick that vaccine coverage globally, the less we have to worry about the new variants.
In the U.S., when can kids under the age of 12 start to get vaccinated? Do we have a sense of when that will begin?
Yeah, I think the studies are happening right now. And so I would imagine that we'll start to see that those programs move forward as fall school comes back. I don't know the exact time. I haven't kept up on when they're planning for those studies to finish up, but I do think we will see kids getting vaccinated in the near future.
Lauren, if we look at this July, what we're waiting for is under age 12. When do we see that?
Under age 12 getting vaccinated?
Yeah.
I think that we have to wrap up the studies for the kids under 12 getting vaccinated, and then those programs will start to roll out. I don't know the timing for when young kids will begin to be vaccinated, but I do think that it is on the docket for sure. And it's a priority to get everyone vaccinated, right? And so as we can take advantage of our vaccine supply, making sure that it's not going to waste, that it's either going to people who need vaccine here or going to global efforts to support, worldwide vaccine coverage to reduce the likelihood of seeing new variants. That has to be the priority.
Lauren, I just want to get a final word from you on the data you're focused on right now, a case study maybe in the UK or Israel for that matter. I was going through the UK's recent data, a little more than 20,000 new COVID cases and 23 deaths within the last 28 days of a positive test. Lauren, your take on the data that you're seeing out of the UK, out of Israel and elsewhere?
Yeah, I think we're just starting to see we definitely are seeing that the Delta variant is more transmissible. We're just starting to see the difference in what the symptoms look like, the difference in the severity. I would love to see more data on that. I think it's great that they're releasing these studies quickly, as quickly as they get them, essentially. But it does look like it might be more severe. We just have to wait and see what the data show on that severity and do all of the hard public health work that has to continue to happen to reduce the likelihood of spread and infection of Delta.
the word we're all hoping to hear a lot through the summer, decoupling of the cases from the deaths and the hospitalizations. Lauren, can we say thank you as well? I know this was your last appearance for Johns Hopkins University. You're moving to Nebraska. Thank you so much from me and the team, from Tom, Lisa, and myself, for everything you've done with us through the last 12, 18 months.
It's going to be a
Thanks. It's been great to be with you guys.
Well, hopefully we can catch up soon. Lauren Sauer, Johns Hopkins University emergency professor of emergency medicine. Fantastic to catch up with her, as always, Tom. And we're all looking at the data, the same data, and we're trying to work out if we do see that decoupling through the summer.
Well, I looked carefully today. I don't see it. I looked at John Burns Murdoch's wonderful work at the FT, and John, the resilience index from Bloomberg is the same way. It's global. I think, John, where we are mid-year is the disparity between the countries struggling and the ones really doing well. Obviously, the U.S. is in that group. But you're right. Will that be the study 6 months from now, or will it be about the Delta variant?
And Lisa, for that matter, I think Israel and the UK top of mind, two countries that have done tremendously well to get this vaccine distributed amongst a wide degree of the population, and trying to work out how much that Delta variant affects them.
Yeah, the question I have is how much will people follow along with any further restrictions versus say, it's over, we're acting as if it's over, John?
Coming up, Jared Woodard, Bank of America Securities head of Research Investment Institute. The committee man coming up next, 42.77 on the S&P. Just pulling back from all-time highs from New York City. This is Bloomberg.
There's clearly a sense of optimism and enthusiasm out there, just given the strength of the market.
We should anticipate that we can get back to that pre-COVID labor market.
As the countries move out of the COVID, their demand for basic raw materials is going to be very, very strong.
As this global recovery is unfolding, investors need to think more global in their portfolios as well.
Valuations are very, very challenged, though, but the fundamentals are going to keep getting better here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Coming into Wednesday at all-time highs from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Looking at the markets right now, we're down 5 on the S&P to 42.77. We're set to close out the quarter for a 5th straight quarterly gain. And this quarter, Tom, still a tiny one, up by a little more than 8%.
The world's coming to an end. The VIX was, 23? We go out to 30. OMG, go to cash. Right now, 16.68 on the VIX. John, with that visit to 14 earlier. It's been a terrible 6 months in the stock market. It's just been,
14%.
The pendulum of the stock market is just one of gloom.
Tom, one thing that hasn't continued is the bond market sell-off. Through Q1, yields up 80-plus basis points on a 10-year. They've come in almost 30 over Q2.
I mean, if you start with a plan in January, who takes a bigger victory lap than Jerome Powell? I mean, he's got the markets with him. That's a fact.
Should they be on the outlook? This consensus,
that's the
Lisa,
debate.
This consensus around the Goldilocks outlook for this economy in the years to come. Mr. Al-Arian, professor, doctor, whatever you want to call the president over at Queen's College, Cambridge, he's written that piece in the FT this morning questioning that, Lisa.
Basically saying that too much complacency around this Goldilocks scenario could breed more inflation than people are expecting down the line. And this definitely seems like the tail risk that an increasing number of people are coalescing around that is definitely not priced into the bond market. Still hard to see where it's going to come from, John, especially as you start to see a slowdown in the pace of increases in used cars and some of these other entries into some of the higher inflation we've seen recently.
Do the Fed officials start to break? Do they start to pile up one after another over the last couple of months? We've started to see signs of that. We had it from Governor Waller just yesterday. We are now in a different phase of economic policy, so it is appropriate to start thinking about pulling back on some of the stimulus. That's just the subtle evolution in the language from the Fed, an example of it, Tom, over the last couple of weeks, the last few months.
Does it matter, or is it about the data? I would suggest they are exceptionally data dependent.
I'm with you. If it's about the data, that's one thing. If it's about the reaction function, that's something totally different.
It's just an academic exercise.
The problem the Fed has had, though, Tom, and Lisa, I imagine you'll concur, is that every time they say something about the data, people start to conflate the reaction function and a change in the reaction function with confusion around the outlook?
It depends on who's speaking, right? I mean, Fed Chair Jay Powell has been pretty clear about transitory, and they're going to hold fast. What Governor Waller was talking about, though, is a concern about pockets of froth, and the housing market in particular, fueled in part by the Fed's mortgage purchases. My question is, how tailored can the Fed be about how it removes stimulus? In other words, can it remove just one piece of it without disrupting the whole market?
I think Tom asked the right question. At the aggregate level, Tom, house prices in America, the fastest growth that we've seen in more than 3 decades. But you're right to break it down from city to city to state.
Right.
Different picture in different parts of the country.
I mean, the real world, and this is my old life when I traveled a lot more, John. I'm in the lunchroom at Carnegie Mellon with Marvin Goodfriend and the wonderful Alan Meltzer. And Meltzer of UCLA went absolutely ballistic on me in a lovely and friendly way, saying all that matters is aggregate because that's all they have. And yet in the modern day, we're living all the regional senses of this.
Yeah, I'd love to see someone go ballistic at you, Tom, in a
No,
collegial way.
he was really upset because he says, and this is, Hole and Horse talked about this. I mean, the whole lunchroom just stopped at the nerd talk of good friend Meltzer and Keene. It was just, I was trying to keep up.
42.78 on the S&P. I'll whip through the price action
so you
for
go
you
right
briefly.
to the data check
Thank
there
you.
without commenting on it.
Yields in a basis point or two at 145.28.
I had somebody throw a roll at me once in the London School of Economics
I'm
lunchroom.
I've had a few of them, Tom. You're a dollar 118.83, down a little more than 1/10%. The euro weak, a dollar stronger. And keep an eye on crude. Start to pick up again. 73.97, approaching 74. Up by about 1.36% this morning, Lisa.
Yeah,
Thanks, TK.
No one has ever thrown a roll at me. Maybe if we go out for lunch in the next couple of days, that will change. Today, we're looking 8:15 a.m. We're getting that ADP Employment Report. The expectation is for a gain of 600,000 jobs. That is below where we saw the last read of 978,000 jobs. Key will be the components here. How quickly are services sectors bringing people back into the workforce? 10 a.m., we were just talking about the housing market. We get U.S. May pending home sales. The expectation is for it to tick lower yet again. Why? Because prices are so high, there's an affordability question. There's also a supply question because there just have not been homes. And to Tom's point about where the homes are being purchased in suburban areas, in smaller cities, and frankly, the supplies have been unable to keep up with some of the demand. And today we get, of course, the global corporate tax debate from the OECD. Question to me is how much agreement is there heading into the G20 meeting next month? How much can people coalesce around this minimum 15% tax rate? And what's the enforcement mechanism, John, as all of these countries try to roll out some sort of a corporate tax rate that will not necessarily give one nation a competitive advantage over another?
And Lisa, to that point, whether Ireland wants to come along for the Kumbaya ride over at the G7, the G20.
I mean, honestly, they have indicated that they would be willing to. This isn't that big of an increase for them. However, it has been such an economic boon to them to keep a tax rate so low. It is one of their hallmarks, and this really is the key sticking point. Ireland.
Let's turn to Jared Woodard, shall we? Bank of America Securities Head of Research Investment Committee. Jared, always great to catch up with you. Mohammed Al-Arian writing in the FT this morning, the inherent instability of the Goldilocks market consensus. Do you think that outlook, that nice Goldilocks outlook that many people have, Jared, do you think that is unstable?
Well, thanks, John. First of all, I think that Mohammed may be hoping for a consensus where I certainly don't see one. I mean, thinking about investor comments and questions this year have been entirely dominated by fears about things getting too hot, too much stimulus, too much, central bank easing. Is the reopening happening too quickly, for markets? I mean, these have been the questions that have been constantly put to us, and I think that the truth is, as you guys were joking at the beginning of the segment, the markets have digested all this incredibly well. The VIX is at 16, not 30, and so the big takeaway for us is that, in fact, the most contrarian view, I think that the most out of consensus thought right now is that things might actually continue to go well. You may even start to see some deflationary forces kind of work their way back into the system in the second half of this year and the start of next year.
Jared, what percentage of long-only buy-side, the more traditional investment, is off their bogey? If they're tight R-squared to the market, they want to be like the S&P 500, or even if they're removed from it on the edge of hedge fund. How many people are behind right now?
I think a lot of people have gotten positioned for reopening from reflation. They've gotten into some of these value trades, some of the cyclical sectors, especially financials and energy, materials a little bit. But they're not completely offsides. In fact, in most of our measures, our internal, proprietary measures suggest that investors have pulled back in positioning over the last several weeks. They're somewhere closer to neutral from much more aggressive levels earlier this year. So I think that the fear of aggressive investor positioning, that people are overly exuberant about the market, and that's going to give us some kind of volatility. I think that might be a little bit misplaced here.
Lisa, this is incredibly important in that the behavior wrapped around all this blah, blah, blah we do is critical. And as Mr. Woodard says there, people aren't on board the bull market enthusiasm.
And you can see this particularly in the bond market, right? The fact that we did get that bid into the long end. We do see a flattening yield curve. And Jared, do you think that the bond market and the message there that is a lot less bullish than the message from equities is translating into the equities? Have we seen the full play out of a less inflationary reality within the equity spectrum?
No, I think Lisa, it's exactly in the equity market where you'll see, the biggest potential change over the second half of this year. If it's true, our economists have been suggesting, for example, you could see some downward pressure on price indexes from goods as people shift from goods to services. As September, unemployment benefits expire and all the kind of consumer behavior changes into this fall, you could start to see some of these short-term price pressures actually moderate in the way that economists and Fed officials have been promising for some time. People a few months ago were, terrified of the cost of lumber. You can't go to the store and buy some plywood. Well, lumber's fallen 50% from its peak, and so none of these, disinflationary or even just return to normalcy sort of economic pressures, I think, are factored into the equity market today. People are still on one side in terms of the reflation trade. A much more balanced portfolio, which is what we've been recommending for a while, I think is going to suit investors better as reopening becomes normalcy in the economic market and in financial markets.
Jared, always sharp. Super smart. It's good to hear from you. Jared Woodard there, Bank of America Securities Head of Research Investment Committee. And just to go through some of the additional notes in the note that we had from Jared this morning, he talked about lumber being down by more than 50%. Platinum's down 20 on the quarter. Gold is down 18%. Cobalt negative 19. Soybeans down 19%. Wheat down 17%. Pork down 18%. Copper down 13%. That's the quarterly performance. And in the previous month, that's when we saw break-evens top out. And Tom, this goes back to what you said about the shape of the yield curve in the previous hour. Have we seen those peak inflation fears in this market already this year?
Folks, we do a lot of conversation. We do it on radio and TV, blah, blah, blah. You know what? You look at the Bloomberg terminal, John, and the fact is the Bloomberg terminal is giving me a completely different story. And I go back to the Hotsius interview of, 10, 12 days ago, where he models out to sub 3% GDP.
Lisa, your take.
First of all, I love that blah, blah, blah has become the trope of the morning, Tom. When you look, though, at this 50% decline in lumber, you have to also put into perspective over the past 12 months, I believe it's still up about 120%.
Oh, sure, totally.
So it's been a huge run up. But I think to your point, John, have we seen peak inflation fears? I don't know. Jared was just saying we haven't necessarily seen it play out fully in the equity market. And that perhaps will be the interesting part of the next 6 months.
Not for me to say, of course. But when you look at the bond market, when you look at market-based perceptions of inflation, they have declined markedly. They topped out in May. They rolled over through June. And the equity market, to some degree, has reflected that, Lisa, with the outperformance of tech and the underperformance of, say, banks down 6% on the month.
Right. And this, to me, is a really interesting thing that basically equities are reflecting the same message, but to the same degree. Is there some sort of incoherence? And that's what Jared was talking about, that perhaps it has more to play out, this disinflationary idea in equities.
Just a little flavor of the debate for the second half as we close out the first half of 2021. Coming up in the next hour, 8 a.m. Eastern Time, Seema Shah, Principal Global Investments Chief Strategist. Your equity market, -3, down almost 1/10% to 42.79 on the S&P 500. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden reportedly is planning an executive order that would rein in the power of big business. According to the Wall Street Journal, the order would direct regulators to toughen up oversight of industries they think are dominated by a small number of companies. The action would most likely be challenged in court. And a divided U.S. Supreme Court has refused to lift the federal moratorium on evictions during the pandemic. That will leave the ban in place until the end of July. The vote was 5-4. Justices rejected calls by landlords and real estate associations to block the moratorium whilst their challenge goes forward. The plaintiffs argued that the CDC exceeded its authority by imposing the ban. And a big foul-up in vote counting in the race for mayor of New York City. The city's Board of Elections took down previously reported results in the Democratic primary after mistakenly counting test ballots. That produced about 135,000 dummy ballots that skewed results. The inaccurate count showed Brooklyn Borough President Eric Adams losing a large part of his lead over former city sanitation commissioner Catherine Garcia. In North Korea, Kim Jong-un says a grave situation stemming from quarantine negligence has created a crisis. Kim hinted at coronavirus risks that could affect his rule. The regime has long denied that North Korea has had any infections. State-run media isn't providing any details. North Korea has taken drastic quarantine steps that have made its economic crisis worse. Chinese ride-hailing service Didi raised about $4.4 billion in its U.S. IPO. The company sold about 10% more shares than originally planned. Didi is the second largest U.S. listing of Chinese company after Alibaba. Shares begin trading today on the New York Stock Exchange. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
It would have to come back very quick. The unemployment rate would have to drop fairly substantially, or inflation would have to really continue at a very high rate before we would, take seriously a rate hike in 2022. But I'm not ruling it out.
He's not ruling it out. That was the Federal Reserve Governor Christopher Waller speaking to Bloomberg yesterday afternoon from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Your equity market this Wednesday on a 4-day winning streak. Yesterday, just about 42.79 on the S&P, approaching 42.80. There you go. Negative 0.05% on the equity market this morning. Yields come in almost 2 basis points, 145.28 after declining almost 30 basis points through the second quarter. In the FX market, the euro a struggle. The dollar has been dominant over the last couple of weeks or so. 118.85, Tom, on euro dollar. We're negative there, 0.1%.
In EM, John, I do want to point out the ascent of the Brazilian real. The real stronger here through the second quarter as well, I think is really of note. We heard that on commodities yesterday. Right now in Washington, Emily Wilkins joins us, Bloomberg Government. And Emily, what I find stunning is sliding into the end of this quarter, both the New York Times and the Washington Post above the fold barely discuss infrastructure. Explain the de-link here of all the news flow out there from the nitty-gritty of the infrastructure debate and what Washington does in the coming days to make this an important debate.
So at this point in Washington, the biggest news on infrastructure is happening behind closed doors. We need to get these details of the bipartisan infrastructure plan, as well as what Democrats are going to put forward as part of their estimated $6 trillion reconciliation plan. And until we know details, it's going to be really hard to see how much support these bills can get, where the sticking points are, what the fault lines are going to be. We are expecting to start to see text of those bills within the next month as the timeline gets to the point where lawmakers are going to need to start deciding whether or not they vote on them, and leadership's going to have to start working on things. But at this point, we just don't have the details, and that sort of halted a little bit the public debate.
Who are the players behind closed doors? Are they names we know, or are they new people we really haven't spoken of?
That really is the names that we know. I mean, this is very much in leadership's court right now. House Speaker Nancy Pelosi, Senate Majority Leader Chuck Schumer, Senator Bernie Sanders on the Budget Committee in the Senate is going to be a key player here, as well as Congressman John Yarmuth. He is Senator's counterpart in the House. He's the chairman of the Budget Committee there. And of course, Tom, your favorite, Richard Neal on Ways and Means will be writing the tax portion of this bill. And so he's definitely going to be a huge key player in the next couple months.
Emily, is there a middle ground between a $579 billion bipartisan bill and a $6 trillion spending package that's passed alongside that bipartisan bill? In other words, is it a pipe dream for President Biden to try to appease both sides of the aisle and his most further left constituents?
I mean, it might be a pipe dream, but it's a pipe dream that he is aiming for. And he has this one thing working for him. Democrats, despite the fact that across the board they have many different ideas about how big or how small this package should be, realize that they need to get something done. They are all united on that. They all want to see a bill. They all realize that their control of the House and the Senate after the upcoming midterm elections could ride on that. Democrats want to be able to go back to their constituents back home and say, hey, we were able to pass this, we were able to give you this benefit is now coming from us. And so Democrats do want to pass something. It's just, once again, devil is in the details here. Exactly how big can Joe Manchin go and how small will progressives allow it to become?
Let's talk about the details of taxes. The $579 billion plan did not have tax hikes attached to it. What kind of tax increases are we looking at for the reconciliation bill?
I think the first thing you're going to look at is right back at President Biden's plan, what he proposed with corporate taxes, what he proposed with capital gains taxes. I mean, those are things that Democrats are still considering and that a number of, particularly from the progressive wing of the party, say are really popular. They say that the tax structure is unequal and that these measures of taxing the wealthy, the billionaires, the corporations are things that a lot of Americans support.
Emily, it is the end of the first half, rather, and the one major player who, to me, has really not been in the bright lights is Speaker Pelosi. How is she doing?
I mean, Speaker Pelosi has a very difficult job ahead of her. She's got a margin of about 3 to 4 individuals in the House, and she faces the potential of losing people from both ends, from the more moderate end as well as the more progressive end. She has an incredibly tough job here, Tom, not to mention the fact that Democrats aren't really facing good prospects for 2022 just because of historical precedents and redistricting, never mind everything else going on. But you know what? Pelosi has so far managed to keep her caucus together on a number of particularly difficult votes, and she's confident that she can do so going forward. I mean, from the Democrats I talked to, they say, you know, there might be some internal grumblings about Pelosi, but everyone recognizes that at this point, she is the best person for the job of Speaker and of keeping Democrats together. But
Emily,
it's definitely not an enviable job.
I just want to finish up on how much pressure there is for Justice Breyer to retire, how much Democrats are trying to get another nominee in before possibly they lose majority.
Well, yeah, I mean, Breyer Watch ended yesterday with the end of the current Supreme Court term. I mean, there's definitely pressure. There's definitely the sense that Democrats don't want to see what happened during the Trump years with a Republican getting to replace so many different members. I think that pressure is going to continue in upcoming years, but I think for now, at the end of the Supreme Court session, it's taking a little bit of a rest.
Emily, just quickly, when do we hear from the President of the United States today?
We're going to be hearing from him a little bit later this afternoon. He was in Wisconsin yesterday, had a big rally there, and that's the first of several we're expecting to hear from the president as he tours the country and really sells his infrastructure plan.
Emily, thank you. We'll leave it there. Emily Wilkins, Bloomberg government reporter on the effort down in D.C.
John,
Tom.
do you see how it's 92 degrees in Washington and her plant is just killing it, sitting behind her? For those
Well,
of you
on radio, please explain.
On radio, she's got the best plan of anybody we talk to.
It's fake.
And it's just like killing it.
It's swamp-like down in D.C.
Yeah.
That's what Anne-Marie Hordern was telling me yesterday afternoon, Tom. She's surprised by how swamp-like it is.
President Trump called it a swamp.
Down in D.C.
You know.
Well, a swamp in more ways than one. I think Anne-Marie was talking about the weather, Tom.
Just the weather.
Not so much about the people down there, Lisa.
Yeah, I mean, the weather has been a major focus, and I do wonder how much President Biden is going to use that to sell infrastructure, given the fact that the grid... I know,
Summer.
I took it
It's
serious.
partly July.
No, it's not just summer. It was, 118 in the Northwest? This is unheard of.
I mean, seriously, John, I put the chart out moments ago. Somebody else did it, of the weather pattern of, I think, Seattle. The mathematics of getting to the last 3 days in Seattle is truly unimaginable.
It's going to be a hot one today,
it's
too.
It's a mathematical framework, John, that you say that can't happen.
Just one final line, Tom, on New York. Politico going with this line, not so in New York, after 135,000 dummy ballots were counted. Or rather,
Lisa, weigh in here. Come on. Lisa, your grandmother was on the Board of Elections, right?
All right. For the record, just my grandmother was not on the Board of Elections, but I will say my take is this really creates a problem for ranked voting. You know, if this is sort of the protocol going forward, how confusing it is. And if Eric Adams is not the winner, there's going to be a pretty big battle and skepticism around it.
If I'm elected, free beer.
Is that it, Tom?
That's it. That works every time.
What about free fruit? No?
Canned. Only canned.
Coming up,
Ukraine, England,
of Morgan Stanley.
The death stare.
You've missed that joke a little bit earlier. I'll clarify later. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio this Wednesday morning. Good morning. Here's your equity market, 42.79 on the S&P 500. Futures come in almost 0.1% on the S&P. On the Nasdaq unchanged, on the Russell down by 0.4%. As we close out the first half, the S&P 500 up by 14%. The fifth straight month of gains on the cards, the fifth straight quarterly gain on the cards as well. The S&P 500 over the last quarter up about 8%, but things have started to change over the last month. It's the composition of the gains. I want to slice and dice this market for you just a little bit. Switch up the board and look at this. Going to go through things from the Nasdaq 100 and just take a look at the banks. So the Nasdaq 100 over the last month advancing by almost 6 percentage points. The banks on the S&P 500 down a little bit more than 6%. This in line with the direction of travel on Treasury yields through Q1 up by almost 80-odd basis points. Through Q2, down almost 30 basis points. And here's the key question for me. You hear a lot of people talking about peak growth. Let's talk about peak inflation here, not just from the equity perspective, but from the bond market. Switch up the board and finish on this. In a previous hour, I asked a simple question. When was the last time you heard someone talk about break-evens? There's a good reason for it. There's a bias in this market and the coverage of it that when they smell inflation, they scream.
No.
And then when break-even start to roll over, you hear nothing. Tumbleweed through the bond market.
John, this is really important. You got to stop there, John. This is really, really, really important. John, there is a massive media bias to get all lathered up about inflation.
And nobody's talking about this now, Tom. Why? Because we peaked back in May, pushing 260. For those of you interested in break-evens and the jargon of the language, all it is the real yield on the inflation-linked maturity curve. Subtract that from the nominal yield, and that gives you an implied rate of inflation, a market-based implied rate of inflation. It's not an exact science. People talk about it as if it is, that we can just strip it all out nice and carefully and come up with a market-based perception of inflation. But it gives you an idea, Tom, of the positioning in this market right now around the inflationary story. And for now, at least, and this is not a judgment on the future, it's an observation about what's happened in the last month. We peaked in May, Tom.
Well, this is great. I mean, you're going on your edge of Fibonacci for me right now, John. Let's save on that. We'll save on bonds for a moment from now.
Okay. Yields. Want to focus on a little bit later with Morgan Stanley. Let's get you some movers with Romain. Hey, Romain.
Good morning, John. A lot of focus once again here today on the home builders. This time, though, it's going in the opposite direction. Remember, Pulte Homes and a lot of the home builders had rallied for about 3 straight days here. They're taking a leg down here today. We're getting a downgrade here coming from Goldman Sachs, taking it down to neutral, saying the valuations have gotten a little too stretched for some of these companies and that the profit growth outlook, it has to slow down a little bit from some of the torrid pace that we've been used to here. The biggest volume mover pre-market, that belongs to Virgin Galactic Space. Of course, last week it closed out around $56 a share, just shy of that all-time high. It's down 16% over the first 2 sessions of this week, down 4% here in the pre-market. A downgrade there coming today. This from Bank of America. They're taking it all the way down to underperform. This is the first sell equivalent rating that we've had on Virgin Galactic. Again, valuation appears to be the concern. We did get some earnings this morning. This from General Mills. Overall, they were good with regards to the fiscal fourth quarter numbers, but they gave an outlook for full year fiscal 2022 and the growth rates, at least when it comes to organic net sales and EPS, that growth rate is going to have a negative sign in front of it. That's causing a little bit of concern here in the market. Flip up the board here. I want you to keep an eye on what's going on in the semiconductor space. Micron having a phenomenal few days here. It's on a 6-day winning streak. It actually snapped that streak yesterday, was down slightly to close, but now up about 1.5% pre-market. We get earnings from them after the bell tonight, and most analysts, they are incredibly bullish on it, seeing a few price target upgrades this morning. Also, AMD rallying here as well. They finally got unconditional EU approval for that Xilinx deal. Remember, UK signed off on it yesterday. The company already has the go-ahead from the U.S. and South Korea, which means this deal could close by the end of the year. Investors like to see that. And Altimeter, not a stock we talk about a lot. It was a tiny biotech company that was developing a COVID vaccine and went from $2 a share to about $33 a share, down 35% here in the pre-market. This after the company saying it's not going to actually bring that COVID vaccine to market, saying that some of the testing that is done just not aggressive enough here for it to continue now weighing its options out there for what it's going to do next.
Romaine, thank you so much. It is mid-year, and for those of you on radio and TV and for all of global Wall Street, this is without question our conversation of the day. Frank Fabozzi owns the high ground on the literature of fixed income, and what you learn in reading Fabozzi, and when you go all Fabozzi, you learn that there's a complexity here, John. John, it's just not a simple yield down, price up kind of analysis. There's some real complexity.
Well, let's talk about that complexity now. Vishy Tripatur joins us, Morgan Stanley head of fixed income research. And Vishy, let's start with just a simple one. The headline from your research, credit is vulnerable to a negative surprise. How so, Vishy?
Basically, the valuations in credit have gotten so tight that there is not a lot of room. There's not a lot of buffer for any change in the Fed's response function. If we have any change in the expectations about the liquidity backdrop that the Fed has been providing for a long time now, and any of those kinds of a hawkish tilt from the Fed, we think is going to be negative for credit.
Vishy, what do you say to people that think there's a massive put here from the Fed in credit at the moment, that we can't have wider spreads because the Fed is there to back things up?
I think there is. You can think of that there is a Fed put, but since you put it in that language, I would say that put is significantly out of the money put. You need to see the put is not. It's not an at the money put. So you need a substantial dislocation in the credit markets to occur before the put can come in. So it's not that we won't see 15, 20 basis point widening, and that the Fed put becomes functional. You need to see the order of magnitude of what we saw in March of last year. That level of dislocation in the market. Companies, high quality companies, losing access to the credit markets. Those types of dislocations you can conceivably imagine Fed stepping in, but not for a 15, 20, sort of a more, 20, 25 basis point type of move in investment grade spreads.
Vishy, your projection here has a pretty profound implication. That is that perhaps credit spread trades more in tandem with Fed policy than actual credit worthiness of companies. In the past, these were two distinct issues where typically when the economy was getting better, credit would do better. The spreads would actually come in because these companies had a better chance of doing well in that economy and paying back their debt. Have we moved to an area where credit does not necessarily track the ability for a company to pay back its money, its borrowings?
I think it's good to distinguish between what's happening in the high quality investment grade credit versus high yield credit here. I think what you just said is probably more true for the high yield companies, but investment grade credit is really at pretty much historical tights at this point. And the credit market has been a substantial beneficiary of quantitative easing and the low rates, and any change to that, we think there is not enough of a buffer in terms of spreads for the credit markets to absorb. Not so much when you look at the high yield. There is some buffer there for that to happen. So as the economy gets better, the prospects there is still some prospects for high yield bonds and leveraged loans to get tighter, but that room for tightening is simply not there in investment grade. Therefore, what we see is this the situation where there's a clear difference between high yield and investment grade.
This is actually a fascinating discussion and highlights why so many investment managers prefer high yield, even though it's known as riskier to investment grade right now. Vishy, can you walk us through the pathway of transmission? The idea here of if the Fed does get more hawkish, does that mean higher benchmark yields, higher spreads or wider spreads, and then all-in losses that are really substantial? Is that what you're projecting here?
Actually, I'm not suggesting any all-in credit losses. We're not suggesting a defaults will pick up. What we are suggesting is the compensation for investment grade. The spread is the compensation for taking on that credit risk. If you look at, can it get tighter as the economy gets better? Can the markets actually accept lower compensation for taking on investment grade credit? That's that it's really not that much a scope there. On the other hand, if the economy, if the rates get higher, the amount of liquidity in the markets eases somewhat, could they get wider? We think that very much the case that they could get wider without affecting the overall default rate.
Vishy,
in fact, we think defaults will go down.
In the equity market, and I want to pick up on that theme in just a moment, in the equity market, when you bring up the prospect of exuberance and bubbles, people always benchmark it to what happened in 2000 and say, well, it's nothing like then, so there's nothing to worry about now. In the credit market, they'll look at spreads and say things are tight, but they're the tightest since 2007, and this is not 2007. Could you do me a favour? Can you adjust where spreads are at the moment for quality, for duration, and give me a better picture of the parallel between now and 07?
Right, we do that, and my colleagues just recently published a piece just addressing that. So adjusting for everything, we still think we are at pretty close to taking all of those factors into account. You are at all-time tights in investment grade, not so much in high yield. There is a substantial room in high yield, roughly 100 basis points in terms of adjusted spreads in high yield bonds. But in investment grade, we are through the tights of 2007.
All-time tights on IG, potentially. Right. Vishy, unreal. Good to catch up. Vishy Tripatua, Morgan Stanley, Head of Fixed Income Research, on a bit of a clinic, Tom, on what's happening in the credit market at the moment.
It's a clinic, and what's so important about credit, John, and we really haven't, I'm guessing that we really haven't seen it yet. You get priced down at retail or institutional, one statement, next statement, and then it becomes a bear market. And that's been widely predicted 6 months ago, price down, yield up. And we really haven't had that 3 months of statements where people go, wait a minute, what's going on?
We've got a flavour of things, though, just there, Lisa. That the default rate is heading in the right direction, and it's hard to move the other way on where credit is at the moment.
I've been thinking right now, as he was talking, first of all, he's projecting another taper tantrum type of event, except really isolated to investment grade, right? Because spreads and rates possibly rising in tandem. The foreign buyer, to me, is the marginal buyer. At what point do things widen out enough to bring everyone flooding back in? How much of a control is that for how much things could get out of hand here?
And let's quantify what a taper tantrum, if you want to call it that, would be this time around.
15 basis points.
15 basis points plus a spread widening is what potentially Morgan Stanley are looking for. And that's because the tights right now, what are we, 80 basis points?
Yeah.
So 15 matters. What a world. From New York City this morning, good morning.
The Austrian 100 years tight.
How's that working out, Tom?
It's just working out great.
Tom
130 to 90, thank you.
Lisa Abramowicz, Jonathan Ferro, 42.79.
Rachel from Indiana told me to go long Austria. Look where that worked out.
Okay. Did you pay for that advice?
I did. 130 down to 90. I got crushed.
Get your money back. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The US and Taiwan will discuss semiconductors and vaccines today at a long-delayed trade talk. This is a global shortage of computer chips. Taiwan is one of the main suppliers, and its biggest manufacturer is building a new factory here in the US. Taiwan's eventual goal in the talks is a full trade deal. In China, President Xi Jinping is set to deliver a speech tomorrow that links the Communist Party's 100th birthday with the country's return to wealth and power. Xi will make the case that the party, with him at the top, is China's best hope for more growth. Rehearsals suggest the event at Tiananmen Square will include flyovers by the country's most advanced fighter jets. The British government has revealed its post-Brexit system for overseeing subsidies to companies. It's promising to make quicker decisions than when the country was in the European Union. Subsidies will be allowed if they follow certain principles like benefiting local communities and being good value for the taxpayers. Credit Suisse is considering an overhaul of its wealth management business. Bloomberg has learned the Swiss lender may consolidate several private banking units. The move would replace a regional structure, and it may reduce costs as well as present a more unified approach to clients. TripAdvisor and Expedia are tightening safety rules for vacation rentals. Expedia's short-term rental business has banned hosts who use its platform from leaving house keys in public places. Meanwhile, TripAdvisor's reviewing its policies to better protect travelers. The two companies say the moves are related to a recent Bloomberg Businessweek investigation into violent crimes at Airbnb listings. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
is key is that central banks have to be very watchful, in particular advanced economy central banks, in looking the performance of inflation expectations. And certainly they should be very watchful so that they are not unanchored. So far, we haven't seen that, and that is a good omen.
That was Augustin Carstens, now the Bank for International Settlements General Manager, the former governor of the Central Bank of Mexico, from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Closing out Q2 with one trading day still to go, and closing out the front half as well of 2021. In the equity market, 42.81, unchanged this morning on the S&P 500, coming off the back of 4 straight days of gains. Into the bond market with yields heading south, lower, negative a basis point on a 10-year yield to 145.61, and crude just south of 74 at 73.94. But what a year we've had so far, up more than 52%, the most, Tom, if we ended the year right now since 2009. Quite a run in crude.
Well, the run there in crude and the others, frankly, I'd go right back to the equity market. We're going to focus now, John, but I just think we've almost become jaded, John, don't you think, coming out of this pandemic?
Oh, yeah,
desensitized. We lost scale.
I think we're totally desensitized.
Remember single-digit return?
We're up more than 40% on energy stocks on the S&P 500, Tom. Unreal.
Yeah. Well, there we are. David Wilson with a chart. David, Tesla's a failure. I mean, it's only $655 billion market cap. Berkshire Hathaway, 632. I mean, I need the romance of $1 trillion market cap, or I just can't exist.
Well, then the chart of the day is the one for you, no question. What it does, it looks at the 5 companies now that have reached that $1 trillion mark. And bear in mind, the latest, Facebook, kind of backed off it yesterday, closed at about 998.
997.77.
Well, there you go. In any case, it really just kind of marks how much more quickly companies are getting to this $1 trillion mark than they had in the past. Facebook got there just a bit over 9 years after going public. Let's put that in context. Google's owner, Alphabet.
How long?
15 years. Okay. Amazon.com, 22 plus. Okay. And then 33 for Microsoft, 37 for Apple.
John from England emails in and says, should Apple, Microsoft, Amazon, Google, and Facebook, should they all be Dow components?
Well, I mean, if they were, it would skew the average like crazy. And, of course, the challenge with the Dow specifically is that it's a price-weighted index. And so, you get these share prices, like Amazon as an example. I mean, they would have to make some kind of an adjustment to make it work. I'm looking at Amazon closing at almost $3,450 a share. I mean, you have to remember with Apple, they did a 7-for-1 stock split, and then they went in the Dow. So, you have to take that into account relative to the S&P 500, where it doesn't matter.
John, I'm sorry, Amazon with a 40-to-1 stock split, I think it seems normal. Lisa?
Well, John from Coventry is going to bow out in discussing the Dow. I've heard he doesn't really like that, so to speak. Dave, there is a question about why some of these tech stocks have been able to shrug off regulatory risk, especially at a time when President Biden is saying he would like to go it alone to be a little bit harder when it comes to restricting large businesses and how much control they have over different industries. Why is there such complacency in the market that nothing will ever get passed on this front?
Well, in part, it's been a while since we've seen this. And in the past, I mean, regulators, legislators, any moves they've made have taken years and years to play out. And in the interim, you're talking about companies with relatively fast growth. And, you look at what's been going on in the last few weeks. I mean, we sort of had this shift back toward growth, away from value, which kind of ruled the roost for the better part of a year. And so if you're talking growth, you are definitely talking these big tech companies.
David Wilson with us, and of course he dies in about 2 weeks into the earnings season as well. Guys, I think that's a really important thing to look to, is that this earnings season is different. John, I just, you mentioned yesterday, July 13 for JP Morgan. I think, John, we can say we've never seen anticipation for the discovery of information in an earnings season like what we've got coming.
You brought up the Dow, so let's go there. And let's use JP Morgan. JP Morgan, the weighting on the Dow. Little less than 3%. What do you think Goldman's is? Goldman Sachs is weighting on the Dow a little more than 7%.
That's good math.
Apple, 2.5%.
That's good math.
Less than 3%. Goldman, A little more than 7%.
What would Amazon
I keep
be?
going back to that.
If Amazon was in the Dow with that pricing, where would they be?
1%? Depends what their price is. I mean, their price would be what? 30%?
Yeah.
40%? Of the overall, come on, it's ridiculous, Tom, and you know it is.
It is. This is, folks, to review this at mid-year. John's 100% correct. The S&P 500 is a lot better gauge and discovery of this, or even the broader indices.
But Tom, do you know what?
Well. But there's a romance to the Dow. The Dow, the Del Monte man would have quoted the Dow.
It's not even the components and the weighting of the Dow. It's not that it's just price weighted instead of market cap weighted. It's how people reference the Dow. When I tune into other news networks and hear we're up 300 points, we're down 400 points, what does that mean?
They don't do this every day, John.
What does that mean?
They don't do this every day.
It's just not, I think it's misleading. And I think for certain people that don't check in on the equity market on a regular basis, I think it can scare them in some days.
Yes. Oh,
we're down 200 points. That used to mean something decades
John, it's
ago.
not that it scares them. It boosts ratings. Stop.
You think it's a ratings game?
Absolutely. The Dow is down 500 points. We're all going to die.
And then we do the VIX in percentage terms as well. Lisa, it's ridiculous.
So for people who are just tuning in now, the Del Monte man reference is Tom's beige suit. And John Ferro aptly said that he looks like the Del Monte man. So just to clarify,
if you want to Google it,
that's what we're talking about
and they
there.
did Google it.
They have, and they continue to. There's also a question, and I think that, Tom, you raised the point earlier, not to sidestep the Dow debate, but to talk about earnings and to talk about how there's going to be...
You're sidestepping it, to be honest with you.
To sidestep the Dow debate. You know, the earnings, the information, what's going to be more interesting to you, John? The margins and whether we've gotten to peak margins, this whole idea there, or whether people are overestimating or underestimating just how much the earnings growth overall is. I mean,
Am I allowed to say both? Can I say both? Am I sitting on the fence if I say both?
Yeah, absolutely you are, but you'd like to?
I can tell you that the likes of Jonathan Golub at Credit Suisse are saying focus on the earnings, and people are saying we're still underestimating the path forward here. And I can tell you at Morgan Stanley, the focus overwhelmingly has been focused on execution and the margins. Over the last quarter, at least.
John, there's been one huge surprise. I got a segue here. Europe ascendant. I mean,
outperformed,
from where you sit and when you read strategists, do you suggest it has a trend and legs to it, or was it a one-off?
Some people believe that catch-up needs to continue. Bob Dole. Caught up with Bob yesterday, Tom.
Yeah, I love
He's one of those that agree with that. What surprised me, I think, is not the outperformance on the Euro Stoxx 50, given what's happened with cyclicals so far this year. It's what did not happen in the FX market. I was looking for a stronger euro off the back of that kind of equity performance, a weaker dollar. That didn't develop.
I think that it's honestly, I don't see how the euro could strengthen if the sort of main idea here is that the U.S. has to tighten first. The ECB is not going to tighten first. They're not going to be the first mover, period, full stop. So how are we going to get a stronger euro?
Just typically when you get that cyclical upswing, it usually breathes a little life into a weaker dollar story. And what's remarkable is that euro topped out. The strongest point for the euro, the single currency this year, was the first week of the year.
Yeah, and what's amazing, John, is the Tots had a coach then.
They got a coach now. Have you hired anyone?
They're close. They're
close to hiring.
Nuno.
We haven't even talked about England, Germany yet.
Well, Nuno's more important with the Tots than England, Ukraine.
I could say some headaches in the city of London this morning. Bacon sandwich, white bread, brown sauce, and maybe half a pint, just to get back on a road. This is Bloomberg.
I have no idea what he just said.
As this global recovery is unfolding, investors need to think more global in their portfolios as well.
As the countries move out of the COVID, their demand for basic raw materials is going to be very, very strong.
There's quite a bit of momentum that's going to spread out into 2022 and 2023.
You may even start to see some deflationary forces kind of work their way back into the system.
The Fed now needs to transition and think about risks of higher prices, higher inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on TV. A simulcast, a mid-year simulcast. Really interesting to see what we have in 15 minutes as we begin our coverage, John, of the American labor economy.
The Adp report about 15 minutes away. Payrolls coming up on Friday. Payrolls, the estimate in our survey, Tom, 700K.
Well, 700K and the dynamics there. One, we all missed it in the first half, that huge miss on employment, and then we got better at it. Maybe we'll see where we we are this time. John, the research piece overnight, Ronnie Walker writing with Jan Hatzius over at Goldman Sachs, talking about here's the supply-constrained inflation, and it will drift away.
And when will it drift away? We're talking about the end of summer, the start of fall, Tom, August, September, October. For that reason, if you've got to wait until then to get a clean read on the data, what's the pressure on the Fed to make a move before we see that economic data, Tom?
In the market, what's so important here, folks, is the market speaks, and Lisa Abramowicz, yield always leads the way, and yield and spread is speaking right now.
Yeah, the yield is going lower, expecting this sort of disinflationary or confirming the transitory view of the Federal Reserve.
Yeah.
But you're also seeing tighter credit spreads. It goes back to what John was talking earlier. Goldilocks. Are we back in Goldilocks, as Mohammed El-Arian was writing in the Financial Times?
Lisa, you know I don't care about auctions. I don't care about supply. But the fact is issuance is a big deal. Was there issuance, and was there a change in that dynamic in the first half?
In the first half, there was a record pace of issuance, particularly for riskier debt. However, a lot of it did go to paying down existing obligations. One interesting note, collateralized loan obligations, which are these sort of leveraged packaging of leveraged loans.
Oh, those CLOs.
Yeah, CLOs. They record pace of sales. All-time high.
Very good. John Ferro, we sort of missed him in the 6 o'clock hour this morning on radio and TV, noted worldwide off of England, Germany as well. John, what's your observation here of this exceptional victory of England as they marched to Kiev?
I was surprised. I don't have much faith in the manager, Gareth Southgate, but the players got it done. Raheem Sterling got to be the best player at the moment of that England team. They go on to Ukraine. They're in the easier half of the draw, and you'd have to imagine on that half of the draw, I think it's easy to say they're the favourite to get in the final.
Okay, they're a favourite to get in a final, but seriously here, do they play Italy at some point?
That would be a final if Italy get to the final. Italy play Belgium on Friday. They play the winner of Spain, and they play, I believe, Switzerland. So the four on that side are the stronger teams for the other side of the final. That's what the bracket looks like right now, Tom.
Let's save ourselves with the data right now, not the football data, the soccer data, equity markets. I'm sorry, John, it's a give back, but that was a close that we saw yesterday afternoon.
It was a squeeze, another all-time high, just about a fourth straight day of gains on the S&P, 42.79 on the S&P this morning. Yields are coming in a basis point or two to 145.28. Your 10-year yields down on the day and on the quarter. In the FX market, a euro, a break of 119 in the last 24 hours, 118.89. We come in 0.1%. And let me just sit on this just for a moment. Out on Twitter, Magnus Macro, that's the handle on Twitter. To be clear, I'm going to quote this. Inflation is transitory, does not mean that prices return to pre-transitory effect levels. It means the elevated rate of change in prices is not likely to persist. What's amazing is we've spent 6 months of this year arguing past each other about two different things. It's about the rate of change that this Federal Reserve believes in transitory. So if you sit here and say, well, the price of X has gone up, it's going to stay there, it's permanent, it's not transitory, you're arguing about two different things here. And it's amazing how still we haven't come to the right definitions of certain things to have a basic discussion about what's happening in this economy.
John will discuss that on The Real Yield. Look for that on Friday. I have a show in development, Down in Flames with Calculus, and you can look for that transitory discussion.
That sounds brilliant.
John is so rattled by England, Germany. I think he made a bet in Bitcoin. Lisa, save me here for 10 seconds of Bitcoin talk. 34,000 on BitDog. Do we care?
We care just simply because of the regulatory environment. And actually, there is a hearing down in Washington, D.C. at 10 a.m. in the House of Representatives on crypto assets. So perhaps we'll get something on that.
That's amazing, John. We bring up Bitcoin, and she nailed the discussion.
I expect nothing less.
She just nailed that. Let's save ourselves with Seema Shah here. June 30, 2021. Seema Shah with Principal Global. Seema, what did you change in your mid-year outlook?
Hi, Tom. In terms of the changes, I think that how we started the year isn't too different. We came in, I think most people are expecting inflation to pick up. We had a timeline for tapering. I don't think anything has changed yet. If anything, the summer is going to be a little bit more difficult. I think we should see a bit more volatility. I think there's a lot of vulnerabilities in the market. But we're still holding on to our 10-year target of around 185 by the end of the year, and I don't think much has changed on that.
This goes to the quote from Peter Cheer of Academy. I'll be catching up with him in an hour or so.
Thank you for promoting that.
Take some gains, reduce risk, and enjoy a few weeks with less stress. Do you agree with that, Seema?
Well, I think the thing is that for investors, they need to look through some of the noise over the coming months. There isn't too much to be worried about if you're looking at taking a 6 month to 1 year view. There is still a strong economic recovery underway. You may get a few concerns around the Fed, concerns about inflation, and given how expensive equities are, there's certainly vulnerability for a bit of a kind of a tumble here and there. But the long-term view is certainly continued strength in equity markets.
And many people believe continued strength in cyclicals as well. And Seema, it continues to be an either-or. Cyclicals, value, or growth, which basically for many people comes down to big tech, energy, or financials. Take your pick on a sector. That's your style, your factor. And I'm trying to understand, Seema, can you envision a scenario where the S&P 500 just finishes the year lower from where we are right now?
I mean, look, I think it's entirely possible. And this is one of the reasons why I think increasingly investors need to look under the surface, start thinking about the sectors or companies that you're looking at. And the reason for that is that, look, we still have a generally positive long-term view for secular growth stocks, right? So essentially technology. But if you get to a point where cyclical stocks are doing really well and you have the yield curve once again steepening or just generally yields rising, then tech gets into a bit of difficulty. And given its weighting in the S&P 500, that is a possibility that you have a lower S&P 500, even a really strong growth environment where cyclicals do well. So this is the time that investors need to really understand, not just look at the index, but look at the various sectors that they're investing in.
Seema, on a broader level, I'm wondering, to Mohamed El-Erian's point, do you see Goldilocks being a perilous zone to be in, that it has an expiration date, that at one point, one thing will have to break? Either inflation will either have to break out too high, or the credit cycle will have to start rolling over?
Well, I think with his point, it was interesting in that, I kind of disagree. I feel like people have become more and more aware of the various risks. We have clients asking us, how do we add inflation protection to our portfolio? So I think there is a recognition that there are many different risks out there at the moment. But I think the really interesting part of El-Erian's comments were about the very structural changes that are taking place in the economy, which may certainly end up in slightly higher inflation than we've had over the last decade. Things like the supply chains, how are various companies thinking about their inventories, just even with regards to central banks, the way that they're reviewing inflation. These are fundamental changes which are going to take some time to play out, and I think that's where we need a bit more focus over time.
How do they weigh into your investment thesis? In other words, how do you price in the very specific inflationary pressures of this modern era?
Yeah, so we still think that, look, we do have elevated inflation, and even after this, the so-called transitory effect fades out, we still think we'll have inflation higher than what we've had over the last decade. Not a worrying high, but certainly around that 2 to 2.5% level. And in the medium term, when we have elevated inflation, investors need to have that inflation protection. We can talk about value, we talk about cyclicals, but actually the best area to have that protection is within real estate, because you don't suffer that volatility. And as long as it's accompanied by a strong growth environment, real estate tends to do better in these kinds of environments. So that's where our favorite pick is for this inflation environment.
What do you do on a strategy basis with profitable technology companies?
So we have actually maintained an overweight to tech, and there's a couple of reasons. One is that, from a long-term basis, these companies, they have the strong cash flow, they have the balance sheet, and they are where most companies, if they can survive over this difficult period last year and this year, probably next year, they need to use technology to pivot their business model. So tech is not going away. The other thing is that it's a defensive trade. When we have concerns about hawkish Fed growth outlook, tech tends to do well, just as we're seeing over the last few weeks. To us, it makes sense to have that as your defensive portion within your portfolio and hold it through the long term. The key risk is obviously regulation, but as we were discussing before, tech seems to be able to deal with those kind of pressures.
Seema, can I get everything you just said by just owning the index?
It's a really good question.
Sorry, I misheard that. What was that?
Can I get everything you've just said in the last 10 minutes by just owning the index, owning the S&P 500?
No, I think you really need to actively look at what you're investing in. There's going to be some cyclical sectors that do well. You need to have a little bit of value and a little bit of growth, but you absolutely need to pick well, because over the coming months, as the reflation trade becomes, I remember one of the views before saying, becomes a bit more normal, some of those companies are not going to do as well as they've been enjoying over the last few months. So we need to be a little bit more cognizant, be a bit more active in the way that investors are looking at things.
Seema, thank you. It's good to hear from you. Seema Shah there, Principal Global Investors Chief Strategist. We've got some data for you in about 4 minutes' time. We get the ADP report, Tom, looking for 600K there. Payrolls on Friday, 700K.
John, you just asked the most important question for certainly American Wall Street, if not global Wall Street. Let us focus. In the last 12 months trailing, S&P 500 up 44%. You know what, John? I know you loaded the bank stocks. Lisa and I didn't. But John, that question is so important, not only for the late John Bogle, but everybody else playing the game every day.
Yep, and we'll talk about it a whole lot more through the next hour on Bloomberg TV and radio. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Some data just around the corner. The ADP report in the United States of America, the appetizer before the payrolls report. The main course comes on Friday. 42.79 on the S&P, yields in a basis point to 145.78 as we close out 2Q and the first half of 2021. Good morning to you all. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden reportedly is planning an executive order that would rein in the power of big business. According to the Wall Street Journal, the order would direct regulators to toughen up oversight of industries that they think are dominated by a small number of companies. The action would most likely be challenged in court. A big foul up in vote counting in the race for mayor of New York City. The city's Board of Elections took down previously reported results in the Democratic primary after mistakenly counting test ballots. That produced about 135,000 dummy ballots that skewed the results. The inaccurate count showed Brooklyn Borough President Eric Adams losing a large part of his lead over former city Sanitation Commissioner Catherine Garcia. Russia's President Vladimir Putin has accused the U.S. of playing a role in what he called a provocation in the Black Sea last week. Putin says a few hours before a British warship engaged in a standoff with the Russian Navy off the coast of Crimea. A U.S. reconnaissance plane took off from Greece to observe the Kremlin's reaction. Russia says it used warning shots to force the British ship to leave. In North Korea, Kim Jong-un says a grave situation stemming from quarantine negligence has created a crisis. Kim hinted at coronavirus risks that could affect his rule. The regime has long denied that North Korea has had any infections. State-run media isn't providing any details. North Korea has taken drastic quarantine steps that have made its economic crisis even worse. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
I don't think we get a resolution this week. We expect 700,000 jobs. We expect the unemployment rate to tick down by 1/10, the labor force to pick up a little bit. But I think, as Fed officials have said, it's more likely that we have to wait until the fall till we get labor supply coming on fully and get a greater resolution of this real dichotomy that we're seeing in the labor market.
That was Matthew Lazzetti, the Deutsche Bank chief U.S. economist from New York City this morning. Good morning. Alongside Lisa Abramowicz and Tom Keene, I'm Jonathan Ferro, live on TV and radio. The ADP report, 20 seconds away. Here's the price action. 42.79 on the S&P, down 3 on the day, negative 0.08%, up over the last 4 sessions. Yesterday, just about to another all-time high in the S&P 500, and stringing together a 5th straight month of gains and a 5th straight quarter of gains as well, potentially, most likely, at the close a little bit later. In the bond market, 145.45 as we strike 8:15 Eastern time. Here comes the data. Here's Mike McKee.
Good morning, John. 692,000 jobs. That's the report from ADP in the private sector that we'll call it restored still in June. Now that compares with 978,000 in the month of May. And of course, the U.S. payrolls number has undershot that significantly the last couple of months. Let's take a quick look here at the breakdown. It looks like evenly distributed with a little over 200,000 jobs created in small, medium, and large businesses. By sector, manufacturing up by 19,000 and construction by 47,000. Remember last month in the payrolls report, we had a weak construction number. It looks like a rebound there if ADP translates. The service industries provide the most number of jobs, 624,000, of course. Leisure and hospitality, 332,000 of those as restaurants, bars, hotels, etc. start to reopen. So a good news number here, just about what was forecast for the payrolls report, which was 700,000. The forecast for ADP, 600,000, so it comes in stronger than anticipated. And we will see if this leads people to start to raise their forecasts for Friday.
And a market unmoved. Equity futures still down about a point. In the bond market, yield still lower by a couple of basis points, 145.95. Let's call it 145 on a US 10-year. And Mike, you touched on it. A lot of people will see this data and they'll ask a basic question. It's the ADP report. Tells me nothing about Friday. Why do I care?
Well, it does point to at least a strong labor market, whether or not it matches up with the non-farm payrolls number. And we've had a number of numbers like that. Yesterday, we got a really interesting number from the Conference Board that showed people's belief in jobs readily available exceeds the number of people who believe jobs are hard to get by the highest margin ever. And so it looks like people think there are jobs out there which should draw people in, which should raise the participation rate, and perhaps does give us a stronger than expected payrolls number.
I got about 8 questions, Mike, to get ready to the payrolls number on Friday, but let me go to the real wage. And the zeitgeist right now is a reality of inflation. The real wage, the Atlanta wage tracker, less inflation, is a stunning negative number. Do you care?
You care, but I don't think you can make much of it yet. It's going to be interesting to see when these numbers work themselves out, because we're dealing still with base effects. The people who lost their jobs were the lower paid, and so that raised average hourly earnings during the crisis, and now they're coming back, and that's going to push down on earnings. It's probably going to be maybe October before you get a clean read on payrolls if we have to wait for jobless claims benefits to run out to get everybody back into the labor force.
Mike, one thing I'm struck by is the number of quits, and I know that this data doesn't show that, but peripheral data has shown that people feel a lot more empowered when it comes to job prospects. We saw that at the University of Michigan Consumer Survey, Sentiment Survey as well. Do we have a sense of how that's affecting employment? In other words, about how much that's pressuring wages up?
It's probably it's people taking advantage of higher wages at this point, or career changes. They maybe don't want to work for a company that's going to force them to come to the office every day, something like that. It's not going to have a significant impact on wages. It's more a following number, the fact that people feel jobs are available and they can probably make more money by switching.
Very good. Michael McKee, thank you. We're diving into 3 days of coverage. Mr. McKee tomorrow on claims and then jobs on Friday. Right now, he is from the 6th District, Lexington, Kentucky. It must be a Republican. We know that. Andrew Barr joins us. Andy Barr. And what Andy Barr knows is the Fayette County Board of Elections is run a little bit better than the New York City Board of Elections. They can count the votes down there. Andy, to go to the votes in your election, you're not a borderline congressman. You won 57.3% to 41% for the evil Democrat. What do the Republicans need to do right now that are in much tighter districts to make 2022 a good outcome?
Well, I think we need to address the concerns of the American people. You just were talking about the labor shortage crisis in the country, concerns about inflation. These are real. The Fed says, and Janet Yellen say, that it's transitory. I'm not so sure. When you talk to the home builders, when you talk to people who have to purchase the lumber and the steel, and you talk to the restaurateurs who are buying food and the trucking companies that are dealing with higher fuel costs, inflation is real and it's a crisis. So I think speaking to those basic pocketbook concerns of the American people is what's going to deliver the majority back to us. But it's not about the politics, it's about solving these problems, and we do have challenges facing us in the country.
What should Jerome Powell do in his policy? Should he address Lexington, Kentucky, or should he address something like New York City? He's got to address us all. How does he do that?
Well, I think what the Fed should be doing is listening to Robert Kaplan, the president of the Dallas Fed, who has been the most hawkish on this inflation question. And to his credit, Chairman Powell has encouraged these dissenting voices to talk about the real issue of inflation. And we do not need to be buying $40 billion a month in mortgage-backed securities with home prices going through the roof. This is fuel to what could be another bubble, and we need to watch and guard against that. Look, we've had historic levels of monetary and fiscal stimulus pushed into this economy. We are in recovery, but this is fueling a potential asset bubble that could create major problems going forward, and we don't need a situation where the Fed is forced to slam on the brakes and push us into a recession.
Congressman, let's talk about the infrastructure spending plan, the $579 billion bipartisan deal that was struck. At what point would you be willing to sign off on that, even if there were a reconciliation bill that was sort of attached to it, the Democrats were pushing through? Do you have a price tag on how high you would be willing to accept for that bill?
It's not as much about a specific price tag, Lisa. It's more about are we focused on core, real infrastructure? And we're not tying it to an unrelated Green New Deal or social spending agenda that has nothing to do with the needs of the country. Look, we need a bipartisan deal to rebuild our country's infrastructure. Look no further than 75 miles north of my home district in Lexington, Kentucky. You see the Brent Spence Bridge falling into the Ohio River. This is a major source of interstate commerce tying Detroit to Tampa through Cincinnati and northern Kentucky. This is a critical infrastructure project, but there's more of these all around the country, and we need to rebuild our country's infrastructure for growth, for safety, for the efficiency of our economy and productivity. But the key is, are we going to do so the right way? Are we going to do so through streamlining permitting and regulatory reform and slashing red tape, which would save $3.7 trillion? Are we going to do it through private capital as opposed to imposing huge new taxes on the American people that would make us uncompetitive and force U.S. corporations to move towards inversions again and move capital and jobs overseas? That's the question. What does it look like, and is it really focused on core infrastructure?
Congressman, would you be willing to sign off on the $579 billion plan, regardless of what happens elsewhere, because of the need that you were talking about to rebuild some of those bridges and roads?
Yeah, the bipartisan deal struck in the Senate looks good. But what was very discouraging is when President Biden, I think his hand was forced by the extreme far left and the progressives to tie it to this reconciliation bill that would massively expand the welfare state. I think him walking that back gives us more hope. But look, the Democrats are having a really hard time right now internally deciding what it is that they can do.
But Congressman, would you sign off on the $579 billion plan regardless of what happens on the other side?
Yeah, I've looked at the kind of the broad parameters, and it looks positive, much better than where the administration started. So the details have yet to be put into a bill. So I would want to see that before I would commit to it. But yes, certainly this is much closer to, or in the ballpark, if you will, than what we were seeing earlier from the administration, and untethering it from all of the other far left-wing agenda it gives us hope that there can be a bipartisan agreement. I would be surprised if we got there until the fall because of the demands of the far left in the House. And the president can show some real leadership here by pushing Speaker Pelosi to abandon the far left fringe of the party and come to the center and really focus on core infrastructure as opposed to the Green New Deal or some of these other social spending priorities of the Democratic Party.
Congressman, always appreciate your time. Let's catch up again soon. Congressman Andy Barr there of Kentucky. Thank you. Endorsing the words of Dallas Fed President Mr. Robert Kaplan.
Yeah.
We'll catch up with President Kaplan a little bit later today. An exclusive conversation, Tom, at 12:10 Eastern Time, sitting down with Michael McKee.
It's not a small idea. I believe, John, you did. Maybe Lisa mentioned it earlier. This new, not divide, but just this percolation of language. And John, to Michael McKee, when he visits Jackson Hole, you wonder where we're going to be that third week of August.
It's very, very clear there is some dissent.
Yes.
We're going to start to see some formal dissent Lisa, in upcoming meetings?
Well, the key is, are we going to see from the big three, Jay Powell, Vice Chair Clarida, as well as John Williams of the New York Fed, are we going to see them reiterate some of the comments from the other members that we're hearing? My question actually is a more nuanced one, and that has to go to the mortgage debt that a lot of people were talking about, including Congressman Barr. Can the Federal Reserve stop buying as many mortgage bonds without disrupting the market more broadly? You know, can they have a surgical move here, given the fact that this will foreshadow a rate hike, and the market will act as such?
Governor Wallace sympathetic to that idea. He spoke to Bloomberg and he said that. Here's the problem. President Williams, well aware, and he said this in the past week, Tom, well aware of the broader signaling that any reduction would provide financial conditions.
And one of the high points of the first half was your interview with John Williams, and it was a non-interview. I mean, there's a real delicacy here.
Was that a compliment?
Yeah, that's a compliment to you. John Williams didn't want to participate.
Thank you.
Period.
This is Bloomberg. Closing out the second quarter from New York City this morning. Good morning, alongside Tom Keene. Lisa Abramowicz, I'm Jonathan Ferro, 24 hours away, 48 hours away rather, from a payrolls report. Payrolls Friday coming up. Claims are 24 hours away. We'll get them tomorrow morning. Yields 146.46. Yields unchanged on your 10-year. They did come in just a little bit following the ADP report. We give some of that up, Tom. Euro-dollar 118.78, and your equity market down almost a tenth of 1%, 42.78 on the S&P 500.
To be fair to John, folks, for all you on radio and TV, it's nothing like the West Coast, but it is summer in New York. It's hard to concentrate when it's 92.
Thanks, Tom.
95.
Is that fairness?
I mean, vet Bill and Kennel
just doubling down on the insult.
That's exactly right.
Vet Bill and Kennel Fee refused to go outside. They just.
Well, it's that hot. I agree.
It's just like, no. So there we are. What we're going to do right now, we just had Michael McKee on ADP Report. We're really going to dive into Jobs Day right now, which is a sequence from ADP to claims and then to that huge raft of economic data on Friday. Thomas Kostridge is with us with Pictet, and he is optimistic.
Hi, good morning.
Is he out at 1 million? Do you have to do 950,000 because your general counsel says you can't say 1 million because it's a big, ugly, round number? Is that how it works?
There is indeed. I think we could get 1 million, but probably more likely over the summer, maybe in July and August. So I was a bit shy of that, but I think we could get there. Let me frame this payroll report. I mean, all economic indicators I'm looking at are strong, especially with regards to, if you look at high frequency data like gasoline demand, even electricity use, passenger travel, they're all very good. They're, going up. I think that bodes well for payrolls on Friday, and I think we could have even better payrolls over the summer.
Do you just assume whatever the given number is or trend line and all that we mop up 8 or 9 or 10 million unemployed out X number of quarters? Is that just a given?
Right. So I think the momentum could slow in the second half of the year because the easy gains in payrolls will definitely be in services. And, we have summertime coming. So that's peak job growth in services. But after that, it will be, more difficult to add new jobs. So the marginal gains could slow in the second half of the year. But, let's focus now on this summer's jobs data, which is likely to be very strong. And we have time to focus on the later, what happens later this year will be another story.
Thomas, do you think the Fed has time?
I think the pressure will grow on the Fed to announce QE tapering. I think the debate at the Fed is shifting. I think they were looking just at this crude, this loss in employment since February last year, which is around 8 million jobs. And I think they are having a more granular approach to the labor market because I think it's much tighter than what the pure look at the unemployed would say. And I think if you look at job openings versus the unemployed, I think it shows you that the labor market is actually much tighter than what it looks. Yeah.
So what's your base case then for the participation rate in America, Thomas? There is this belief that it just recovers. And to your point, Raphael Bostic of the Atlanta Fed, President Bostic saying the U.S. is 9 to 10 million jobs short, pre-virus, a long way to go. Do we get there?
I think we'll get there. But again, I think there are some structural issues which have actually nothing to do with the Fed or with monetary policy. And we know many people retired, so I think we need to count them out. I think jobs have changed as well. So, I mean, the structure of the labor market has changed as well. So, at the end of the day, I think the view is that there is still some cyclical slack left, but not that much. So I think we could get there actually sooner than what many expect. Not saying that there are still some lingering issues, structural issues that will linger in the labor market, but that's probably beyond what the Fed can address with monetary policy alone.
Thomas, I'm preparing myself for the roaring debate about whether the enhanced unemployment benefits have hindered people from getting back into the labor force. The Wall Street Journal running a story, where they were saying that early numbers seem to suggest, at least from places like Missouri, that more people were coming into the labor force after the decline in benefits. What are you going to be looking for to confirm or to deny those arguments as people try to chart out potential policy going forward?
Right. I do think the high unemployment benefits have had an effect on labor force participation. The question is, of course, how much? I think the problem is that the regional data and the state level data comes with a lag, so we won't have it on Friday. And by the way, we'll have to wait until this summer's data to have a better picture, because many states are in the process of canceling those extra unemployment benefits. But I think we won't get the true picture for probably 1 or 2 or 3 payroll reports. But we'll definitely get a good sense by August. And by August, it's when the Fed is likely to send a signal about QE tapering.
Thomas, we've reached a point where people basically dismiss the Phillips curve as irrelevant to the current paradigm. But are we going to go back to a period where if the labor market gets tighter than people have basically been expecting, we will see a resurgence in the Phillips curve, in this relationship between the number of people who are applying for jobs and the wages that they are getting paid?
Right, and it's a difficult relationship, to be honest, because we've seen that in the past, the coefficients, so the marginal increase in wages coming from the labor market slack is actually quite limited. So there's limited. The Phillips curve is actually in our jargon is actually flat. The thing is also you have two relationships here. You have one from the labor market slack to wage growth, and one from wage growth to inflation. And you have two relationships here that are actually quite fragile. And I would say that we're not yet in dangerous levels in terms of wage growth. The U.S. economy can absorb higher wage growth without really creating a higher inflation. What I'm really going to be looking at is inflation expectations, especially from the business side, actually, because they are the one setting prices. And you see actually a creep up in those inflation expectations. So that's where I'm a bit more vigilant. The fact that inflation expectations are actually starting to move up, and including those of businesses.
Thomas, you just stumbled on a problem a lot of people have with these kind of conversations on networks like this, when economists say things like dangerous wage increases. I'm not sure anyone's ever been on the receiving end of a dangerous wage increase. What is a dangerous wage increase?
Right. So right now, I mean, the one metric I'm looking at is the Atlanta Fed median wage growth. We're around 3%, right? So 3% inflation is actually way above that. So actually, there's a loss of purchasing power if you discount wage growth by current inflation. But I think we should be, if we go up to 4-5%, I think we won't get a direct link between wage growth and stronger inflation until I think we get to 4.5-5% on wage growth. So I'm quite serene about wage growth, and indeed I do think that there's more room to go before I start to sound the alarm on inflation. Again, the one thing I'm looking at is inflation expectations, because that's where you can have a virtual loop between inflation expectations and actual inflation starting to kick in. And so far, we're seeing a slow creep up in those inflation expectations. So especially from businesses. Again, that's the one I'm looking at.
Thomas Kostek, thank you, sir. Pictet Wealth Management Senior Economist. I'm not sure anyone's been on the receiving end of a dangerous wage increase. I'm sure many corporations feel like they've given plenty of those out, Tom.
Yeah.
over the years.
But yeah, I take your point on that, John. It's June 30th, and to stay on Switzerland, John, Mark Heffley and the team at UBS come out with a blistering note. This is what you see at the end of the quarter, John, where they stake their territory. UBS says, go with the banks. And critically, John, go with the global banks. Their math is they're trading at a forward price as compared to earnings ratio of 12 times. They pound the table by the banks.
And they make 3 points, 3 basic arguments. I'll go through it one by one. Earnings growth looks set to remain robust. 1, 2, valuations remain compelling. And 3, the trend towards higher payouts will not be limited to the United States. Lisa, in UBS's view.
Yeah, this comes after the stress tests. Those big U.S. banks passed them with flying colors and then started announcing distributions that are expected to amount to in excess of $140, $150 billion. The key aspects that I think people are digging into are the first 2 issues. The idea of earnings going forward at a time when we're not seeing consumer loan growth and loan demand picking up. We're not seeing necessarily interest rates picking up all that much. And I do wonder, John, how much you can divorce the view of the banking industry from that of the rates view. I mean, honestly, is this just going to trade in tandem with that macro call?
Yep, and let's think about what we've done over the last year or so. The last year, fantastic for the financials. The banks, I think, up close to 30% on the S&P 500. Year to date, over the last month, down about 6% against the NASDAQ 100, which has advanced 6% over the last 30 days. That's some huge divergence between what big tech has done on the NASDAQ 100 and the underperformance of the financials. And the point that I think UBS are making this morning, Tom, is that, okay, we acknowledge and recognize the underperformance recently.
Yeah.
We think that lag won't last.
And John, this is going to go right into a wonderful guest you've got coming up. I believe you got Richard Bernstein scheduled from Bernstein Advisors. He wrote the definitive book on this, John. I'm going to say 20 years now. I think he was like 19 years old. And it's on style investing. And what we're all saying, John, cyclical growth and all that, is what are we comfortable with? What is the style that we're going to have? It's a great time to talk to Mr. Bernstein.
He has been committed to the cyclical story. And it's a belief that it goes beyond reopening, that this can persist, that, Lisa, somehow this is more durable. It's not just about turning the lights back on and this is what outperforms in the first part of the story, that this continues. There's more chapters to go.
And I think a lot of people also take a look at these dividends, and just to put them into perspective, the fact that you get an 8 to 9% payout based on the market cap of some of these banks, it looks pretty good when you look at high-yield bonds that are yielding 3.7%.
Coming up, Richard Bernstein, Bernstein Advisors CEO from New York City. This was fun this morning, wasn't it, guys? Good morning. 42.77 on the S&P. Yields in a basis point, 145.78. Can we repeat the performance of the first half in the second half? The man from Del Monte says, what does he say, Tom?
Go to cash.
I thought the first half, I thought England in the second half was a little bit better. I mean, was Kane like really in the game other than his goal?
I think it's important that he got a goal. Can he kick on from there and build a bit of confidence? It's always good for a striker to get one in the back.
What is Ukraine football like?
Good last night. Explosive on the break.
Explosive on the break.
Need to see a little bit more of that. They've got some pace going forward. You can just say that all the time, Tom. What I just said, just cut that. And you can say that about football, and you'll always sound like an expert, okay? A hot, hot, hot New York City. Stay safe, guys. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. The US and Taiwan will discuss semiconductors and vaccines today at a long-delayed trade talk. There is a global shortage of computer chips, as we know, and Taiwan is one of the main suppliers, and its biggest manufacturer is building a new factory here in the US. Taiwan's eventual goal in the talks is a full trade deal. In China, President Xi Jinping is set to deliver a speech tomorrow that links the Communist Party's 100th birthday with the country's return to wealth and power. Xi will make the case that the party, with him at the top, is China's best hope for more growth. Rehearsals suggest the event at Tiananmen Square will include flyovers by the country's most advanced fighter jets. Goldman Sachs is looking for a new office space in Dallas. It would be the company's largest presence in the U.S. outside of its New York City headquarters. Offering alternative work environments is becoming a post-pandemic trend. Private equity firm Thomas Bravo recently opened an office in Miami in addition to its San Francisco and Chicago locations. In a Bloomberg Front Row interview, founder and managing partner Orlando Bravo said it's important for colleagues to be in the office together.
By offering a very different location on the East Coast with a very different lifestyle, different culture, different norms. We're able to offer our colleagues two different ways, two different places to be where they can collaborate in an office environment.
They have $8 billion under management and does deals exclusively in the software space. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Can't wait to see everybody. Our businesses and residents really sacrificed a lot in 16 months, and they're eager to bring their workers back and have everybody come in to see us in Washington. So I think we're well on our way to our comeback.
The mayor of Washington, D.C., Ms. Bowser, yesterday in attendance here with Bloomberg, and we thank her for that conversation. Right now, and for those of you international, and indeed across this nation, I guess it's no surprise. The Board of Elections, with a small snafu, as Shelley Banjo would spell it, last night, and I guess we all know about it, there was an election miscounting or that, and they came out at 10:30, and they said, oops, we screwed up, and we'll have data today. Shelley Banjo joins us, Bloomberg New York bureau chief, on a fractured mayoral election. Shelley, I guess it's a news item. What will we learn today from the Board of Elections?
Thanks so much, Tom. So it's basically Groundhog Day all over again. So erase basically any kind of notion of what those results told us yesterday, because what happened was that they included 135,000 dummy ballots. So basically what happened yesterday was pretty useless, and we go back to square one, where we're going to get the new results today.
Absentee ballots, there's 140,000. AP says it's 15-20% of the votes, whatever. Do you know, or can you guess which borough they're from? I mean, are absentee ballots like a Bronx thing or a Manhattan thing or a Brooklyn thing? Do we have knowledge of that?
So if you look, you can tell which districts they're coming from. And so a lot of the districts that the absentee ballots are coming from are from districts that Eric Adams and Catherine Garcia led in the general election. So you can try to make some guesses that it's going to come out the same, as the same or a similar fashion. But it's really hard to know.
Shelley, how much does this snafu undermine the tiered voting that New York City was rolling out this time?
So from an untrained kind of voter eye who's looking at it and all they see is, vote counting fiasco, I think it's pretty natural for the general public to be like, oh, it's because of that new ranked choice voting thing, when really it had nothing to do with ranked choice voting. It had everything to do with the Board of Elections, which has, quite a spotty record of handling elections, making a big mistake. And so I think it will really be up to the city to, continue this education campaign if they want to keep going with the ranked choice voting, to examine what happened and also convince voters that this wasn't what happens in a ranked choice voting system. This is what happens when a Board of Elections doesn't do their job right.
Although, Shelley, it does raise an issue of nuance, and nuance can sometimes be difficult for people to digest. This idea that what if Eric Adams does not emerge victorious even after being the leading candidate after the initial count? I mean, what is the potential liability to people being skeptical of the results if that should happen, if Eric Adams is upended by Catherine Garcia?
I think people should absolutely be skeptical of everything that comes out and look at it with a fine-tooth comb. You have a lot of the candidates, filing, preemptive court papers to take a look at all of this. So even once we have the winner, you better believe it that all these candidates are going to be taking a closer look to make sure that everything was done right. I mean, this is the first time the city has done an election like this at a citywide contest, the first time they're using this kind of new software, the first time there's been so many candidates. There's just so many firsts to this that everybody's going to be looking closely at what happens.
Shelley, are we going to reform the Board of Elections? I mean, I'm by no means an expert on this, but do we compare and contrast with Boston or Philadelphia or Sacramento? I mean, is this the point where maybe there'll be a revolution and we'll leave the 1840s?
There was a real deep investigation in 2013 that just, flatly found the illegalities, misconduct, and all sorts of other issues with the Board of Elections in the city. The problem is it's going to take a state action to fix this, not a city action. So
why is that? If the city wait, I don't mean to interrupt, but the city council of 51 members, they appoint the Board of Elections, right?
Right, but the makeup of it, who appoints it, everything is done by this kind of system of patronage, where the political parties get to appoint these people, and so that is that's a state thing, and so that's going to be something that needs to be reformed in Albany.
Shelley, just taking a step back as we assess the votes for the mayoral election in New York City, the biggest city by population in the United States, where are we in terms of the economic recovery, given the fact that New York has lagged behind other states? Are offices reopening at a faster pace than they were, say, a week ago, given the fact that such a small proportion were actually in their seats?
Yeah, it's a big issue for New York. Our unemployment rate is much higher than the national average. There is a lot of office buildings in Midtown Manhattan, in particular downtown Manhattan, that remain empty. Some of the big banks have been implementing some mandates to bring workers back to the offices, but it's really going to take, a lot to get the city back going again, especially when crime remains elevated and unemployment levels are high.
Shelley Banjo, great. Don't call us Shelley. Just let us know when you figure out what the results are for the mayoral election. I think
will do.
2022. Shelley Banjo there, running all of our New York City coverage and really driving forward 731 Lexington Avenue, I should say, as well. Lisa, we just talked about Mark Hafley and UBS with a blistering note. Carl Weinberg was on fire this morning about something John mentioned earlier. He said this is not inflation, which to most people watching and listening is like, what? But there he is saying it's a one-off event and it will subside. Calm down.
And we are seeing some signs of that with respect to used car values, which are coming down. You're not necessarily seeing that in the new car prices, but you are seeing some of the areas that got bid up the most start to come down from their incredible highs. My question is, what is the level it is going to come down to, and what will the Fed tolerate, right? Because they're going to probably reach their 2% target. That's what a lot of analysts say on a longer-term trajectory. What is the overshoot that they are willing to allow to happen? So even though we know it is transitory, the big pop, the degree, the pace of the increases, what's the neutral that's okay?
Yeah, and Ronnie Walker and Jan Hatzius at Goldman Sachs say, yes, it'll come down, as you say, but they look for some supportive real estate inflation that gets them back to that 2%-ish level.
Well,
see how I said ish there?
Very well done.
If you're dressed like the Del Monte man, you're allowed to say ish.
Thank you. I will have to dress in a beige suit tomorrow. There is a question, though, also about at what point that's disinflationary, right? I mean, the whole real estate going up, well, rents are going up, too, because of the increase in the housing prices and because there is a tighter supply in certain regions. But as you pointed out, very, very different story for New York City versus, for example, in Austin, Texas.
What are you going to listen for from Kaplan with McKee here in the 12 noon hour?
His relevance, his connection to the rest of the key members, the idea here of how much there actually is a sort of cross-listening going on Fed board meetings, how much people are trying to use other people's ideas versus just portray nuance in a very difficult time for them.
I want to hear what he says about Texas. Kaplan reads the data across his wonderful district. I want to know what he sees. Robert Kaplan, incredibly important interview. Look for that in the 12 noon hour today. Michael McKee driving that interview forward. Futures at -4, Dow futures at -36. Stay with us on radio, on TV.